Welcome back to the European Market Open. A minute to go until the start of cash equities trading. Here are your Friday headlines. It's just coming up to 8 o'clock here in London, 9 o'clock if you're in Paris or Berlin. This is the futures picture we have for you, some 15 seconds until the start of the European trading day. We're expected to be fairly flat across these markets, perhaps a little bit of upside coming through in London and in Frankfurt. We should point out US futures point in another direction. They're flat to negative right now, so we'll see how that plays out as we head towards the start of the US trading session. But dealing with things more present, dealing with things more current here in Europe, and this is the start of the European equity trading day, of course. So we have a move of 0.1% to the upside in the UK. We had, of course, very strong data out of the United States. We talked about this last hour with Mark Cudmore. Very strong data out of the US yesterday. Did some slightly counterintuitive things, perhaps, to bond markets, and we'll talk more about that. But we've also had some strong data out of China, not all of it 100% strong. The quarter-on-quarter comparisons maybe not looking quite as good, but there are certainly those positive vibes in the market this morning. The CAC 40 opening, and that to the downside just by a fraction of a tenth, just by a tenth of a percent, sorry. The FTSE 100 up by 0.3%, the IBEX up by a tenth. So we're making modest gains across European equity markets this morning. Let's get back to one of our top stories, though, which is around that Chinese data. A major economic data release from China this morning. Strong retail sales were the standout number, rising 34.2% from a year ago. This as GDP climbed by a record 18.3% in the first quarter on an annual basis. But the monthly picture tells a slightly different story, with growth momentum slowing down. This all comes as rising inflation and soaring debt levels have put Beijing's policymakers on guard. Joining us now is April LaRousse, Insight Investment Fixed Income Investment Specialist. April, very good to speak to you. Thanks for joining us. Let's start with your thoughts on China. We've had plenty of data out from China overnight. Did you get any signals from within all of the noise around this Chinese data? Any signals that changed your view on China?
No, we're still actually expecting to see China produce some pretty decent growth numbers. But of course, remember, they're way ahead in the cycle. So, you know, it's natural that after having seen an earlier recovery than everybody else, that you would start to see slightly cooler numbers. I mean, from our perspective, we know that China's been spending a lot of its time improving its productive capacity, and that ultimately will export deflation to the rest of the world to some degree. We think the PBOC is going to maintain a nice loose policy. They have corporate companies paying taxes this time of year. They also are going to be doing quite a bit of issuance, so it's in their interest to keep monetary policy pretty loose. So when we're looking at Chinese government bonds, what we're seeing is pretty decent value. Actually, they've been bucking the trend, and you've seen yields actually declining on Chinese government bonds, in contrast to the other markets, which for the past 3 months more or less have seen a rise in yields. There's nothing new from the data. Really, it's just going to be very noisy.
So you're bullish on Chinese government bonds at this point. Just how bullish are you on those, and for what reasons then, April? Give us a little bit more detail on what you just mentioned.
Bullish might be too big of a word. I think we think when we're looking at the major developed markets, what we're seeing is, clearly yields have risen already. They seem to have stabilized more recently, but there's scope for them to rise further. Whereas in China, we actually think they have peaked out and are starting to come down. So I think it's more of if you're looking at the different markets, government bond markets, what you're trying to assess is where is the safest place to have some interest rate risk. And we would suggest that China is one of those interesting markets. So it's not quite bullish, but it's more of a safer place to hold your assets.
Are you concerned about defaults at all in the credit space in China? We've been covering the story around Huarong this week quite intensively, something that's been running since the beginning of this month, really, April. Today looks a little different. Today looks a little less tense on that front, perhaps, than earlier parts of this week. Are you concerned about corporate defaults, even these state-owned ones, which seems to have taken people by surprise?
Yeah, it is a bit of a surprise because generally our thinking is that state-owned enterprises will be given more support than obviously the pure private sector ones. But over the years, we have seen that China wants to be slightly more liberal when it comes to how it's dealing with companies that get themselves into trouble, and basically behave a bit more like we do in Western markets. So as with everything you invest in, you should do your homework, make sure what you're investing in is quality, and don't expect that government policy is always going to bail you out. Given the strength of the recovery globally, really, that we're seeing, we would imagine default risk in China overall remains quite low, but clearly there will be some idiosyncratic companies who don't make it.
And looking elsewhere in Asia at this point, April, are there other assets that you're interested in? I know that you like markets, you say, with automatic stabilizers, and referencing Japan there.
Yeah, again, as a sort of safe place to hide, Japan actually represents a reasonable opportunity when you're at this point of the cycle, because, of course, for years, Japan has exercised yield curve control. They've been very proactive about how they're doing their asset purchases, really to make sure that bond yields stay within a nice predictable range. And so, when you're getting other markets such as treasuries, bonds, even gilts, having a tendency to rise in yield, Japan is just not following along in that trend. So again, it's a relatively interesting and safer place to invest at the moment.
April, thanks very much. Stay with us. April LaRousse, Insight Investment, fixed income investment specialist. She stays with us on the programme. Let's get to some breaking news just coming through from Germany. The German Chancellor Angela Merkel is delivering some comments in a speech to Parliament over in Berlin. These are some of the lines that she's giving us this morning. We must halt the third wave of the virus, says the German Chancellor. The situation is very serious. We must take it seriously. She goes on to say that intensive care workers are crying out for help. We're bringing you these live images coming to us from Berlin as Chancellor Merkel delivers this speech. Of course, we are seeing some changes taking place in terms of the ability of the federal government to act to curb the third wave, as opposed to state governments acting here. So that is the sort of political backdrop to all of this. We've also been covering more broadly in Europe the rise in infections broadly across Europe, and indeed tragically the death toll in France, over 100,000 now from COVID-19. So this is certainly something we will keep front and centre. Those live pictures coming to us from Berlin. Coming up on the programme then, we'll get back to financial markets. The largest bond sale ever by a bank. JP Morgan takes advantage of cheap borrowing costs to sell a record amount of bonds. We'll discuss the corporate debt market next. This is Bloomberg.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
Welcome back to the European Market Open. Just coming up to 10 minutes into our European trading day, and we've got European equity markets actually more on the front foot than we'd anticipated, perhaps from the futures picture. FTSE 100 up by around 0.5%. The CAC and the DAX both in positive territory. Let's take a look at some of the individual stocks that are on the move this Friday. Here's Bloomberg's Danny Berger.
Anna, we got their earnings after the bell yesterday, but L'Oreal reacting to that this morning. Shares actually dropping despite the fact that they saw a pickup in their first quarter sales. And Bernstein analysts noted that it was a good start to the year, but perhaps it's because Europe was very weak. Concerns there about another lockdown, perhaps weighing on those shares. Daimler to the upside. Not only did the individual company itself have very strong earnings, thanks to Mercedes sales in China, but we also got European car sales data that was strong as well, erasing some of the earlier declines in the year. Finally, HelloFresh, another earnings story here. Those shares gaining more than 3.5%. Analysts calling this one a massive beat. That's from Deutsche Bank, also raising their full year forecast. Finally, let's get a look on the overall picture of the markets. We had that big slide in U.S. 10-year yields, people going in buying bonds, a lot of the geopolitical tension attributed to that. But at the same time, we are seeing risk assets do more or less okay. We had U.S. futures and the NASDAQ hit another record yesterday, but crude up again on a solid run. So some of that attributed to the better growth picture, despite the fact, yes, S&P futures off so far this morning, Anna.
Yeah, absolutely. Actually, things looking a little just mixed, really, aren't they, in terms of the futures picture now in the US Dow futures fairly flat. We'll keep an eye on that one. Danny, thank you very much, Danny Berger, with your movers this morning. Now, JP Morgan sold $13 billion of bonds on Thursday in the largest deal ever by a bank. The US lender took advantage of some of the cheapest borrowing costs in years to boost its capital after the Fed let pandemic relief measures lapse. Corporate borrowers continue to see heavy demand for debt that provides a decent premium over treasuries. April LaRousse, Insight Investment fixed income investment specialist, is still with us. In April, in terms of the banks using this opportunity as a good time to boost their capital, I suppose low interest rates right now doesn't come as much of a surprise. How do you approach bank credit at this point?
In terms of overall, banks are in very, very good shape. I mean, they have obviously increased leverage like every other corporate, given low costs of debt. But we don't have any concerns about the fundamental quality of the financial sector. With the economy likely to run very hot in most parts of the developed world, banks will not be facing a lot of non-performing loans. So honestly, the financial sector does look quite attractive. In terms of where we have our exposure, we're most interested in the subordinated part of the capital structure, as the senior bonds don't really represent much in terms of valuations.
Yeah, with banks as big issue as April, what kind of signal of confidence does that send, or what kind of signal does that send to the corporate issuance world?
Well, they've already done a heck of a lot of issuance, so we're not particularly expecting to see the need for a deluge more of issuance that happened really in 2020. We are expecting companies to continue to call bonds as they have been, refinancing them out for longer periods of time. And clearly there is still plenty of demand. New issues are very much oversubscribed. But of course, investors are getting a little bit more discerning because valuations overall are more stretched than they were perhaps several months ago. So I think we'll just have to pick and choose as these new issues come.
Give us your thoughts, April, as we have you here, on what is happening in Treasury markets and what happened yesterday in Treasury markets. Strong data. You might have thought that would lead to the reverse of what we actually saw in markets yesterday. Essentially, we had a drop in yields that reflected increased demand for Treasuries, and that didn't seem to be intuitive to many people, given the strength of the data. How did you interpret those moves in markets yesterday?
I think the market is just reflecting the fact that it's already sold off an enormous amount from January to now. We were bound to see some stabilization. You know, the markets were effectively adjusting to the idea that growth was going to be strong this year. And Treasuries obviously wanted to price in the potential for higher inflation and even potentially higher interest rates. And now it's essentially done that. Of course, you've had other news out which would have perhaps helped with the safe haven type feeling that Treasuries have, you know, news on Russia, Johnson & Johnson, vaccination hitch. And so really those two things have obviously been a stabilizing force for yields. But what we're really seeing now is Treasuries effectively taking a breath after having sold off so sharply. And so, you know, they're going to try and establish a range at current levels.
So if we took a breath, and that took us down to 1.57, that's where we're looking at the moment then, April. 1.57, do you expect much movement from there?
I think, you know, we think we're going to see some stabilization for another month or so before markets try and reassess which direction they want to move in. I mean, overall, when we take a step back and we look at what we think the Fed's going to do, you know, they've been very clear with us. They've said they don't have any interest in having tighter financial conditions. They want things to be nice and loose to facilitate this growth and this recovery. They don't think they're going to see any proper inflation, just maybe a little bit of inflation noise with the year-on-year effects, base effects happening this year. And so really the direction of travel for Treasuries is to sort of try and establish a new trading range, but to not shoot higher from really around current levels. So we would expect the markets to really just trade in a range.
If the data yesterday was not enough to test the Fed's resolve, then, April, what kind of data how good will the data have to be to trigger selling of Treasuries and another push higher in yields, do you think?
I think it would have to be what kind of data more than the quantum of data. So I think that the Fed is very much focused on wage growth. And as of yet, we have not seen any evidence that wages are getting out of control. We still have quite a lot of spare unutilized capacity in labor markets, and that's something the Fed is very much focused on. So, you know, a bit like what the Reserve Bank of Australia is doing, they're very much thinking, you know, we're going to look through a lot of this inflation noise, not consider it real inflation until you're really starting to see some tightness and some rises in wage costs. And so really, I think what we're going to see is the markets trying to get, you know, a little bit nervous about what some of these year-on-year inflation figures look like. But ultimately, the Fed will take a step back and want to allow inflation to run hotter. Now, you know, of course, remember, they've just changed the way they're looking at inflation with this flexible targeting approach. And they've changed that at the same time they're actually getting tested. So it's kind of, you know, normal. You would expect the Treasury market to be quite nervous.
Okay, things looking a bit nervous. We'll continue to watch for those tests of the Fed's resolve then. April, thank you very much for joining us today. April LaRousse, Insight Investment Fixed Income Investment Specialist. Thanks for joining us. And April will be continuing her conversation with us on Bloomberg Radio at 9 a.m. UK time. Let's get a Bloomberg Business Flash for all the top corporate stories we're covering today. Here's Laura.
Thanks, Anna. The parent of Mercedes-Benz says that first quarter earnings significantly topped estimates. Daimler's profit was driven by strong demand for its luxury cars, especially in China. Mercedes' first quarter global car sales climbed 22%. Deliveries in China were up 60%. Yesterday, JP Morgan sold $13 billion of bonds, the largest deal ever by a bank. It's taking advantage of some of the cheapest borrowing costs in years to boost its capital. The sale follows the bank's best quarter ever, with investment banking fees up a nice 57%. Chinese carmaker Geely says its new electric car unit Zeekr will give it an edge against big tech in the EV market. Its president has told us that deliveries of the new car are set to begin in September. It's targeting 50,000 sales annually by 2022 after 2 more models are added.
Zeekr
is exactly created for this. It was spun off from Geely
In order to become a brand new company, no matter its brand, products, teams, organization, or its culture, which is no different from any other tech and internet companies.
That's the Bloomberg Business Flash. Anna.
Thanks very much. Laura Wright here in London. Coming up on the programme, US banking giants continue to smash profit estimates and their CEOs are optimistic on the economic recovery ahead. We hear what Bank of America's CEO had to say. That's next. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
In the end of the day, the economy affects a big bank like ours, affects the whole banking, the whole financial services system. And so the good news is, this is a healthcare crisis, and the very good news is you're seeing the vaccine numbers go up. You're seeing the ability then to reopen without the risks that the governments can do in the states and cities and towns. And you're seeing people move around. So our spending levels for our Bank of America consumer customer base were record in the first quarter. March is the biggest month ever. If you go back and compare to 19, they're up 20%. And so divide that by 2, it's up 10% a year, which is much faster than they were growing in 15 and 16, 17. So there's a bigger number growing at a faster rate, and yet people still have a lot of the stimulus in their accounts and haven't spent it. So the world still has we have a group of Americans and a group of people around the world who aren't back to work yet, and we need to get that done, whose businesses can't open yet because of the nature of them. We got to get those done. But a big part of the economy, and I think our prediction is that for the economy to cross over in the next couple of quarters to be bigger than it was before the pandemic, is open and operating, and the consumers are spending money, and that's very good news. And then when you translate to Bank of America, what you're seeing is our deposits are way up because that money went into people's accounts and it's sitting there. But our loans are not as high, fell largely because people are paying us off because they have so much cash sitting around. So now the commercial side, we expect that to change as the economy growing at 7%, which is what we predict will require companies to borrow to service that economy. It's just that companies had a lot of cash too. So we look for more loan growth as the year progresses. But the good news is the consumer's in good shape. There's an unemployment issue. We got to get that the rest of the way down to where it should be. The businesses got to get open. It couldn't be. But by and large, a big portion of the economy is up and operating very well.
Bank of America has a very special viewpoint into the American economy because you have such a consumer, such a retail presence, and also the middle market. You really deal with small and medium-sized enterprises across the country. Are you seeing any pickup in the borrowing from your medium-sized companies yet?
We've seen it bump along the bottom. Usage of our business banking segment, which is 50 million and under revenue companies, and our middle market, which is 2.5 billion. We're seeing the line usage pretty flat. But the good news is it quit going down. We saw in the months during the quarter, January, February, March, it got a little stronger. Our origination activity, meaning new clients and new deals done, is strong, bodes well for the year. But we got to see it come through, and that goes back to those companies having a lot of cash and had to run very efficiently during the crisis because you didn't know what happened next. And now they're going to need to start spending money on supplies and things to redo their inventory. Now, the one thing I think we all have to be mindful is we got to get the trade. The trade is growing fast out of, into the country, but the ports and things still need to get straightened out because of just the dynamics of the virus, and the supply chains are still ironing out. So I think one of the things I worry about for mid-sized companies, can they get the supplies to do what they do? So you've heard about lumber prices or resin and things like that. I think it'll straighten out. We hope it'll straighten out. But that's the next sort of outside the healthcare, the next challenge to get the supply chains really up and oiled and greased and running through to serve that fast-growing economy.
That was Bank of America CEO Brian Moynihan there speaking to us about what they see on the U.S. economy. Let's stick with Bank of America, whose shares slid nearly 3% after results. The lender reported alongside Citi yesterday. Both reported huge growth in trading revenues and banking fees. Let's get more then with Danny Berger. Danny, what were the weak spots in Bank of America's earnings that investors seemed to be trading on?
Well, part of it is what the CEO was talking about there, and that's that tepid loan growth, that people are putting deposits into the bank, but they're not taking out new loans. The loans they do have, they've been paying off. Same goes for businesses. So that means that interest income at Bank of America fell about 16%. I should say, though, this wasn't really surprising. We saw this in banks earlier in the week. This had been expected even before the bank started to report results. So what really took investors by surprise, and part of the chunkiest reason we saw shares decline, were higher costs. Non-interest expense costs is rising by 16% because of COVID, compensation changes, and charges for shrinking their real estate, Anna.
Okay, Danny, thank you very much. Danny Berger with the latest on the banking sector there. Lots to focus on in terms of the results story and the corporate issuance, the issuance of corporate debt by banks. We talked about that a little bit with April Lewis earlier on in the program. When we come back, we're going to get back to our big story around Chinese growth. We'll talk to UG, Chatham House Senior Research Fellow, about China's record-setting GDP growth. We'll be finding out whether the picture is really as rosy as it seems. We'll also talk about geopolitical tensions, of course, and climate plans. We'll also ask about Huarong, the latest. There are a few recent lines crossing the Bloomberg on that subject, so we'll get to that. This is Bloomberg.
know that Norway sells way more electric cars per capita than the US? Norway. Well, I won't stand for it.
In this neighborhood just outside Oslo, the majority of cars are electric. Last year, Norway became the first country in the world to sell more electric cars than any other. In December, EV market share was at 67%. In 2025, the country wants all cars sold to be zero emission.
Hey, Norway, listen up, you fish-loving... Oh, this place is adorable. Damn it.
But why is Norway leading this development? The country is rocky, it's ice cold, and with huge distances. The easy answer is politics. By giving the consumers benefits that pay off, more people will go electric when they're getting a new car. These perks could be no VAT when buying the car, reduced tolls, the possibility to drive in the bus lane, and quite a bit of free parking as well. 2021 is an election year in Norway, and the Climate and Environment Minister Sveinung Rotevatn believe the EV perks will be a hot topic in the campaigns, where removal of the perks is set to be a central issue.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Welcome back to the European Market Open, half an hour into our European equity trading session. And for this Friday morning, we have some brighter looking numbers coming through on European equity markets. If you're long of these markets, of course, going along with some brighter skies, at least here in London. Hope the sun is shining wherever you are. This is the picture then for European equity markets, up by 0.3% this morning. If I look at the sector breakdown, we've got nearly all sectors in Europe in positive territory. Autos and auto parts continue to be one of the booming sectors here in Europe. So that sector up by 1.4% at the top there. Banks also doing pretty well, up by around 1%. To the downside, travel and leisure and healthcare continue to be a little under pressure this morning and are lagging, along with consumer products and services. So that's a sector breakdown. Let's get to some of the top corporates, or some of the top news stories that we're covering here at Bloomberg. A First Word News update from Laura Wright. Laura.
Thanks, Anna. Italy's debt burden is set to exceed the previous record set after the First World War. Officials say this year debt will hit almost 160% of GDP. The government is borrowing another 40 billion euros for stimulus that pushes its overall pandemic spending north of 170 billion euros. South Africa's central bank sees room to keep rates low to support the economy. It's cut its benchmark by 3 whole percentage points since the start of 2020, taking it to a record low of 3.5%. Even if there is another spike in infections, the SARB's governor is wary about tough new restrictions.
There could be a third wave, but even if there was to be a third wave, what you can't do is to have another hard lockdown. As I've said, the lockdowns are smarter. The message that one needs to send as a global community, we need to understand that none of us is safe unless all of us are safe.
Now, we've learned a second UK official took a position at Greensill Capital while they were still working for the civil service. It raises yet more questions about ties between the British government, cronyism, and the now insolvent lender. Prime Minister Boris Johnson has ordered an inquiry into supply chain financing and government interactions with the company. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Anna.
Laura, thank you. Laura Wright here in London. Now, China's setting records with GDP soaring over 18% in the first quarter. The boom was largely in line with predictions, but the figures are skewed, of course, by comparisons with a year ago when the economy was shut to curb the coronavirus outbreak. With us now is GU, Chatham House Senior Research Fellow on China, to give us her interpretation of what's going on here in China in terms of the economics, but also, crucially, the geopolitics, which we'll get onto. Just in terms of the economic story that you see, GU, coming out of China at this point. At the last MPC, we seem to see reduced emphasis on the size of the growth percentage and more emphasis on the quality of growth. What's the significance of that when we look at these GDP numbers, do you think?
Well, that's absolutely right. I think the very clear signal is that if we're judging by the 14th five-year plan, it didn't really set a hard GDP target. I mean, this is for the first time, a 5-year plan without GDP target. That's something very interesting. Now, the only target which MPC set from last month was around 6% above growth. Certainly, China can't handle that, but this would really leave the room for policymakers to run the economy, to really reduce the level of debt within the financial system, as well as just make sure that economic recovery is something sustainable, something environmental friendly as well. So I think that's really give the room. Although this number is quite surprising today, but I mean, that's really come from low-hanging point comparison.
Yeah, difficult to compare, isn't it? Or at least, you know, the comparisons are very skewed, of course, as they will be everywhere as we stage these dramatic recoveries from the global pandemic. GU, I know that prior to your current role, you've had a specialism in looking at Chinese state-owned enterprises and sort of consulting on that subject. So with that in mind, I wanted to get your sense of what's going on at Huarong, and the centrally controlled or state-owned enterprises, at least, and how safe they are at this point. There seems to be rather more speculation around that subject than we might have anticipated previously. Previously, the assumption was always if it's state-owned, it's pretty safe in China.
Well, we can't say, and you know, any enterprise is 100% safe. I mean, at the end of the day, the state will not continuously bail out. I think the policymakers, and especially central bank governors, want to really send a clear signal that deleveraging is one of the key tasks for this government and for the next 5 years. And therefore, there's no way that the central administration will be able to bail out every single company such as Huarong in the way how the mess they've been made so far. So I think they want to send a very clear political signal to the other state-owned enterprises. Just watch out on the balance sheet.
Where do you see the broad relationship between China and the US heading from here? Because, of course, under the Trump presidency, there was plenty of tension. There were plenty of legs to that very tense relationship. That hasn't changed a whole lot under a Biden administration. We heard Blinken recently warning with regards to Taiwan. How concerned are you in the short term about where these tensions go?
Well, I think I'm less concerned, actually, after the Anchorage meeting, because what we had experienced in Alaska, it was very much a public showdown that both sides have to perform to some extent to satisfy the domestic audience. But really behind the door, I mean, I was judging by the press release from both sides that a whole range of discussion has been made, and which had never happened during the Trump era at all. So I'm actually thinking perhaps a baby step to start with, like, for example, the Chinese Space Agency and NASA began to exchange data in outer space. That is really a good beginning already. So let's just assume it is a baby step to somehow to mind this bilateral relations, because simply this bilateral relationship is just too important to the world.
That's very interesting. And if things do de-escalate, that makes life easier for many European countries, of course. How do you sense that the political developments in Europe changing that relationship? I know we have elections coming up in Germany, of course. How is that going to change the relationship, do you think, between Europe and China at this point?
Well, I think the Europeans has really hardened its views towards China in recent years. I mean, that since 2015 onwards. So regarding Europeans, I would say that the agreement, the comprehensive agreement on investment between China and the EU, because so far has been put on hold to be debated in the European Parliament for the sake because of the sanctions and the tit for tat sanctions both sides has been given. Now, secondly, it is also that because France and Germany was really the engine behind push this deal and push this agreement, But since the Germany will change leadership by September this year, so perhaps the successor will less likely to carry forward some kind of like pro-China or pro-economics policy, but more concerned regarding on issues on normative subjects, on values and on human rights and Xinjiang. So I think there's a lot of independent variables for China-EU relations to go forward. And also by 2022, and then it was France will become the president for the European Council. So that again put China in a very difficult and unpredictable situation in handling with the relations with Brussels.
Jiyu, thank you very much for your time. Good to speak to you. Chatham House Senior Research Fellow on China. Jiyu joining us there with the latest on the Chinese growth story and the geopolitics. Coming up here on this programme, the future of work. We speak to Adecco's president, Christophe Catois, about how the pandemic has reshaped employee expectations and what is next. That conversation next. This is Bloomberg.
Asia is absolutely core to our business. It's almost 20% of our franchise revenues globally, which is significantly more than most of our global peers who are more in the mid-teens.
We want to invest, grow in China, but also we are also investing in the rest of Asia as well. Our top line growth for the region has been close to 24% last year, almost 20% of the group's revenue as a percentage of the revenue of the group. So, and this is where the group is counting on the growth.
We see company after company, these are corporates committing to net zero. So pretty much across the board, there is an enthusiasm for putting capital to work to try to get us to a better carbon future.
Credit Suisse has a fantastic brand name in Asia. We have obviously strong positions in Singapore and Hong Kong as our two main hubs, but across the region.
We're early on in this year. I know we've already sort of penciled in 6 or 7% growth and a big fall in unemployment, but under outcome-based policy, we really want to see that.
I'm bullish on the rebound, but I know we have a long way to go before the job is complete.
There's no textbook for this. You don't want to be too preemptive, but I also don't want to be so reactive that we're late.
I think it's too early to talk about changing monetary policy while we're still in the pandemic tunnel.
Our goal is to produce 300 million dosages in 2021 within our network. And then you have to see how many of these dosages can be released, because there is a release process, which is certainly to be accelerated then there as well. And for 2022, we are planning to produce 1 billion doses.
That was Franz Werner Haas, the CEO of CureVac, watching very closely that business's ability to compete with those vaccines that have, of course, have run into some obstacles, in particular their rollout in Europe and the US. Let's get a Bloomberg Business Flash. Here's Laura Wright.
Thanks, Anna. Well, yesterday, JP Morgan sold $13 billion of bonds, the largest deal ever by a bank. It's taking advantage of some of the cheapest borrowing costs in years to boost its capital. The sale follows the bank's best quarter ever, with investment banking fees up an impressive 57%. Chinese car maker Geely says its new electric car unit Zeekr will give it an edge against big tech in the EV market. Its president has told us that deliveries of the new car are set to begin in September. It's targeting 50,000 annual sales in 2022 after 2 more models are added.
Zeekr is exactly created for this. It was spun off from Geely in order to become a brand new company. No matter its brand, products, teams, organization, or its culture, which is no different from any other tech and internet companies.
Anna, does that tempt you to buy an electric car?
I've been tempted. Availability of the model you're seeking is sometimes the issue, not to mention charging it here in London. Laura, thank you. Laura Wright here in London with the Business Flash. Now turning to the labour market. The pandemic has caused a fundamental shift in job expectations. Adecco Group's research shows workers are demanding greater flexibility. 69% of people in a survey run by Adecco say contracts should be based on results delivered rather than hours worked. And in general, they're asking for more home work flexibility. Let's speak to Christophe Catois, Adecco's president, who I'm pleased to say joins us now as we continue to think about the way that work is shifting. So tell us a little about the research that you've done, people's expectations for a split between remote and office work, Christophe. How deliverable do you think that is going to be for the companies that you deal with?
Good morning, Anna. Indeed, due to this survey, we see a big shift in terms of expectation coming both from employees and from employers. And as you have mentioned it, the rule of this game is no more to have a very standard world of work with, the famous 9 to 5 hours contract with work from the office is a rule. Here we see hybrid becoming one of the keywords of this new world of work. What is released by the survey is that each individual has his own expectation and motivation. And even if one of the content of the survey is to say 51% of people would like to work from office for that time and 49% from home, so a good, I would say a 50% of the share of the time. At the same time, some people would like to have 80% at home and some others 80% in the office, because expectations are not the same. So the key message of this survey is to say we need to have a tailor-made approach about our employees and about each of our individuals. That's a key learning from this survey.
So that's one key learning. Another is that 69% of those surveyed say they want contracts that are based on results rather than hours worked, hours at your desk. Isn't that something that's in the workplace already, Christophe? Maybe not the contracts themselves, but the reality of people's work is that often it's very much based on the results rather than a sort of old-fashioned notion of presenteeism, the number of hours the coat jacket is on the back of the chair.
It would be a big shift, and I say it would be because that's not the reality for 100% of our employees today working for our clients. The reality in the gig economy probably is that rule of this game to say you are paid to deliver a content, a result, and not a number of hours. But the labor law in many of the countries are based on the number of hours. And here the expectation from people is to have autonomy, to have a frame, but to have autonomy within this frame to deliver the results. And thanks to that, you need to adapt your time working to your well-being, to your family constraints, and so on and so on. And this shift should be probably released in the labor law also to be, I would say, instrumental in the future. But that's clearly an expectation from employees in this survey.
You also added some insight in your survey into the question of emotional intelligence amongst management, Christophe. What does that practically mean? Your survey is suggesting that many managers felt they were not adequately equipped to deal with some of the more emotional issues, I suppose, that they had to deal with staff over this very difficult period for everybody. What are the practical things that management can learn or invest time to master when it comes to this more kind of holistic approach to management?
Yeah, this survey explains also that all is a question of people and leadership. And among the leadership style expected from people, one very important topic is empathy, resilience, and agility. And what is behind is to say, for example, when people are working from home, probably for people in front of the screen, leaders, it's important to ask the question, how are you today? What about your family? And after to talk about some, I would say, professional topic, but empathy, new way of working is based also on the ability to support and not only to lead, to have flat structure and not only to have hierarchical structure, and to have this ability to put a frame and after to give a lot of autonomy. And believe me, it's not so easy because during the early stage of this crisis, it was a constraint. And now plenty of leaders are expecting to be trained because it's not a reflex. I would say it's a learning.
Right, yes, and there are many different leadership styles, aren't there, Christophe? And some may have found it easier than others. It's interesting in your survey, you say that 50% say their work-life balance improved as a result of home working or as a result of the pandemic, I suppose, broadly. That's interesting because it seems to fly in the face of some of the anecdotal comments I've picked up about Zoom fatigue, about the fact that when you're at home, it's difficult to draw a line between your work and your home life, and maybe the hours you would have spent commuting, you just spend at your desk. How consistent is it, this feeling that home working makes for a happier life?
Yes, 50% is, it's the average. It's you have 50% who say the contrary. So the point is, you can't manage the average. You have 50% who are really pleased to work from home part of their time, to manage their autonomy, to manage also by themselves their well-being, and that's probably a lesson learned here. But on the contrary, 50% said probably it has been painful because it was difficult to focus, to concentrate due to the real estate you have, due to the fact you have children to take care or not. And probably the lesson here is we need not to have one general rule for everyone, standardization. We need to adapt to the situation of each of our individual. And that's probably for the company, the lesson to learn and to keep in mind, especially to keep attractiveness and to make sure well-being is part of the pleasure, but also the commitment of the employees.
Christophe, with the businesses you talk to, how much flexibility are they showing now with regards to the location that an employee is based in or comes from? Is this something that businesses are more flexible around now? I'm thinking of one bank that announced this week that it's setting up an office in the Midlands in Birmingham in England, and another financial institution setting up an office in Manchester. I wonder how much we are going to see places of work spread around countries a little bit more rather than being centralized into large cities. Is that part of the narrative at this point?
Yeah, it's part of the narrative and it's part of the reality, because the ability to shift from one central point of your organization in a headquarter or a shared service center, now you can imagine to have shared service center in companies with people working from home where they live. And you know that we have a lot of expectation from people sometimes to leave the center of the cities in order to live in a more friendly environment. And having the ability to combine this friendly environment for the family being, and at the same time having the opportunity to work for the most important companies or for small companies, it's really part of the well-being and probably part of the attractiveness we could bring to our employees and to attract those talents. And like me, that part of the future at work is also a skill shortage. And that's why this feature is important to take into account again.
Christophe, thank you very much. Thanks for bringing us this interesting conversation. Christophe Catois, Adecco's president, no doubt topics of interest to those working from offices and indeed at home. Coming up here on the programme, Italy's debt burden is set to surpass a century-old record. What's the impact on bonds? We will get the latest with Bloomberg's Markets Live macro strategist Laura Cooper. This is Bloomberg.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Welcome back to the European Market Open. 54 minutes into a European trading day that looks broadly positive, up by 0.3% on European equity markets. Let's talk to Laura Cooper, Bloomberg's MLive macro strategist, who joins me here on set. It feels a little morning after today, doesn't it? After the drama of yesterday, the big moves in treasuries. Just to check where we are right now, 1.58%. We've dropped a long way in terms of these yields in recent sessions. Yesterday we saw very strong data, and at the same time a lot of buying of treasuries. That confused a lot of people. But was this part of just a long-run April trend where we've seen bond buying and yields falling?
Well, I think really the price action yesterday, like you mentioned, was just quite puzzling because we did see Treasury yields tumble by the most since late February. And we've had quite a debate this morning on our MLive team about what's behind that move. So it does appear to be the case that it was largely positioning unwinds. It really doesn't change that longer-term trend for yields to kind of climb higher going forward. But it does point to potential risks of this U.S. growth exceptionalism. Perhaps that's already priced in. Perhaps this inflation fears are overdone. We have seen the Fed come out really convincingly with those rate hike bets being pared back. So I think at this point, we're not going to see a near-term direction for yields, but certainly some caution playing out in the market.
And here in Europe, we're going to be looking ahead next week, of course, to the ECB meeting. We've had some guidance around Italian debt and Italian debt levels. Once again, in terms of the percentage of GDP, a bit of an issue. What are we expecting to see there?
Well, certainly what investors are telling us is that debt burdens are clearly on the back burner. So if we look at what's happening in terms of Italian debt yesterday, we did see it rally by the most since mid-March. But I think ultimately that is another blip in that longer-term trend because the ECB is likely to start slowing their bond purchases in July. That's the latest from a consensus survey of Bloomberg forecasters. And that's because the ECB is likely to be hesitant to really step in to curb that reflation trade because we are seeing that growth improvement come across Europe.
Okay, Laura, thank you very much for your time. Good to speak to you. Laura Cooper, Bloomberg's MLive macro strategist. Have a good weekend when we get there. Coming up here on the programme, that is it for the European Market Open, but we will be bringing you plenty more from our conversation with the CEO of the German pharmaceutical company CureVac after the company's vaccine production goals. The goal is to produce 300 million doses in 2021. We already heard a little clip of that, more of that conversation to come in later programming. That is it for, as I say, the European Market Open. Surveillance Early Edition is up next. Blue skies over London this Friday. This is Bloomberg.
Minority myth wasn't something that was fabricated by the Asian Americans. It was created as a tool to alienate the Black and the Asian American communities, and it was incredibly successful.
We know the racism didn't begin yesterday. We know it's probably not going to end tomorrow, but it is our job to make sure that there's progress and we keep people safe, give people dignity.
I spent a lot of time last year to just listen, to understand, to reflect and understand what I could do as a leader of this organization.
For many years, we've been very shareholder focused, and now there really is much more of a community requirement.
The economic downturn in the U.S.
we're seeing unemployment and income losses affecting women more than men.
2/3 of the jobs lost in South Africa were women's jobs. So I think we're in a moment of crisis.
Clearly, our societies are reproducing, not reducing inequality.
We need better public policy and we need companies to step up.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
The United States is not looking to kick off a cycle of escalation and conflict with Russia. We want a stable, predictable relationship.
The auto industry is a huge network of supply relationships and technology relationships around the world. Our guiding principle is to go for the best.
We have a group of Americans and a group of people around the world who aren't back to work yet, and we need to get that done.
This is Bloomberg Surveillance, Early Edition with Matt Miller.
Good morning. Welcome to Bloomberg Surveillance, the early edition. I'm Matt Miller in Berlin. Here's what's coming up on today's program. Big banks, big bonds. From a record quarter to record debt issuance, JP Morgan sells $13 billion of bonds. Goldman follows suit with a $6 billion sale. Tencent in there as well. We're going to hear from our interview with Bank of America CEO Brian Moynihan on the program as well. China's economy soars by 18.3% year over year in the first quarter, but momentum slows from the previous 3 months to just a 0.6% gain. Strong retail sales stand out, but again, it's the base effects from the pandemics that make it look so good. And the $100 million deli, David Einhorn, presents the latest sign of irrational exuberance, a New Jersey delicatessen with a market cap almost 10,000 times higher than its 2020 sales numbers. So first off, the theme of U.S. bank earnings this week is a rebound in profits. We still have more to come. Boosted by a trading bonanza, but tepid loan growth has investors worrying about future earnings. We spoke to Bank of America's Brian Moynihan.
Consumers in good shape. There's an unemployment issue. We got to get that the rest of the way down to where it should be. The businesses got to get open. It couldn't be. But by and large, a big portion of the economy is up and operating very well. If they're raising because inflation and other things got out of control and wasn't temporary, that's probably not a good thing. So, the question of raising rates is a risk in certain circumstances and an extreme benefit in others, just because it means the economy is normalizing. The number one risk to the world still is getting this healthcare crisis behind us. The best news about the economy, honestly, is the unemployment rate keeps coming down. We're a work-from-office company because of productivity and the culture and the mentoring that can take place is just better. We need to keep critical mass in the places we are and get the people to work.
Let's stick with Bank of America, whose shares slid nearly 3% after their result. Danny Berger here with the details. So, Danny, what were the weak spots with B of A's earnings that investors are trading on?
Well, certainly, as you described, that tepid loan growth is part of it. It's something we've seen in all of the banks. Of course, Bank of America, very exposed to the consumer, seeing their net interest income fall about 16%. Still, as I said, we know this would have been a weak spot in their earnings. We know the other banks did this. So that wasn't necessarily the surprise that really took a hit on their share price. Their share price falling nearly 3%, as you said, Matt, and a lot of that had to do with the higher costs that the bank is seeing. Costs rising nearly 16% for the quarter, leading to this picture. They said that basically the reason that costs were higher is because of COVID, of course, costs associated with that. At the same time, changes in compensation. They're also shrinking their real estate exposure, or their real estate footprint rather, and that leads to charges as well. The CFO saying that, yeah, some of the COVID costs are stickier than we had hoped for, but this is going to be a one-time thing. They're really sure to flag that this wouldn't continue on.
Just a day after their earnings, JP Morgan took some big action, to say the least, the biggest bond sale on record by a bank, $13 billion of issuance. Why would JPM want to increase its capital so much? Is it just the right time to strike with rates so low?
That definitely is part of it, but rates have been low for a while, Matt. So probably the impetus behind this is a change in regulation. So the banks have this SLR, their supplementary leverage ratio, and it basically says, based on your holdings, this is how much capital you need to have set aside. Now, during the pandemic, when the Treasury market seized up, the Fed said, okay, Treasuries and deposits, that doesn't need to count towards your holdings part of that ratio. Now that relief has gone away. So banks are in a situation where they either need to get more capital or do things like sell Treasuries. It looks like JP Morgan going the way of shoring up more capital with that $13 billion worth of bond sales. And investors, for their part, happy to buy anything that has a nice premium to Treasuries, Matt.
Danny, thanks very much. Danny Berger there with a look at Bank America and JPN. Remember, we still have Morgan Stanley coming out at 7:30 a.m. New York time. Let's get the Bloomberg First Word News now. For that, we go to Leanne Gerrans in London. Leanne?
Good morning, Matt. President Joe Biden has delivered on his promise to punish Russia for misconduct that he says was ignored under his predecessor. He's announced sanctions, including the expulsion of diplomats and limits on buying new sovereign debt. We spoke to the head of Russia's second largest lender.
I think inevitably Russia will respond. Russia will retaliate. There will be tit for tat, situation. Unfortunately, we didn't want it, particularly with the view of possible summit between Mr. Biden and Mr. Putin. But we expect that some retaliation will take place.
Now, the pause of the Johnson & Johnson COVID-19 vaccine could last weeks. That's according to the head of the advisory panel, expected to make a recommendation about if and when shots can resume. It's weighing the evidence after reports that 6 people who got the shot suffered rare blood clots in the brain. And Italy's debt burden is set to exceed the previous record set in the aftermath of the First World War. Officials say that this year's debt will hit almost 160% of GDP. The government is borrowing another 40 billion euros for stimulus. That pushes its overall pandemic spending north of 170 billion euros. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Matt.
Leanne, thanks very much for that. Now, coming up, China's economy soars by a record when you look at it year over year because of the base effects. But growth momentum slows on the quarter. We'll talk about China next. This is Bloomberg.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Economics, finance, politics. This is Bloomberg Surveillance, the early edition. I'm Matt Miller in Berlin. Now, CureVac is looking to make 300 million COVID-19 vaccine doses this year and 1 billion in 2022. The German company's shot may have come just at the right time as the Johnson & Johnson vaccine looks set for a longer pause in the U.S. and Europe continues its tentative rollout of AstraZeneca's shot. I spoke earlier with the CEO of Franz Werner Haas in Tübingen.
At least I did completely underestimate when COVID turned up how long this will stay. And I think we have got the technology and the mechanisms now to tackle this one as well. If COVID is going to stay, we have to think about tomorrow as well. If it is going to stay as a, let's say, seasonal infection, which is coming, so we have got with the mRNA technology exactly to tackle this one. Also, we have to see, and this is one of the next sub-studies, what we are starting, how is a COVID vaccine interacting with what you said, a flu shot, for example, which you get every year. And so these are the questions to be answered, but they can be answered.
You had 1.3 billion in cash on hand at the end of the year. To me, that sounds like a lot of money, but I imagine with you, especially producing on spec right now, that must feel a little bit tight. How are you thinking about raising funding?
Yeah, it is certainly for a biotech company. Our budgets look completely different than they looked years ago, as you can imagine, because the building up of the manufacturing certainly is very expensive. But again, what we said before, it is very worth to do it because these manufacturing units are producing mRNA, not only for COVID vaccine, but also for the variants or any other mRNA, what you could. So it's well invested money. And exactly what you said, it's as it is a huge investment, which we have to do. We raised in the beginning of this year in a follow-on financing via the NASDAQ, 517 million. So this is adding to what we have. And then certainly we are expecting and have high hopes that our vaccine will get approved. And then certainly the sales of the product will start as well.
That was Franz Werner Haas, CEO of CureVac. I did that interview in a very dark and stormy period this morning. Later on, though, we'll show you an interview I did with Mercedes CEO Ola Källenius in the blinding light of day. Take a look at China's first quarter GDP numbers. Those are eye-popping, right? Because they're year over year, and the base effects of the previous quarter really skewed the comparisons. If you look at them month over month, it's only a 0.6% gain. So the rebound, not quite as strong as the numbers would seem to indicate. China's growth comes as the PBOC moves closer to becoming the first major central bank to launch a virtual currency with a trial rollout in cities across the country. The Biden administration views the digital yuan as a potential threat to the dollar. But in an interview with Bloomberg, a senior BOJ official downplayed the threat as seen by the U.S.
I understand that PBOC is moving fast to introduce the digital yuan. I believe technology is constantly evolving, and the technology that they're using currently might become outdated. It might even hinder further technological innovation.
Joining us now is Peter Shafrick, RBC Capital Markets Global Macro Strategist. Peter, let's talk first about what's going on in China. In terms of the growth, it looks like a blowout quarter, and then if you look at it following the previous quarter, it looks fairly muted. What are your expectations for, what is really one of the most important engines of global growth?
Yeah, well, first of all, I mean, you just said it, and I think it's absolutely right. I mean, the year-on-year comparisons are absolutely flattering, and they shouldn't be the ones that we are focusing on. I mean, what seems clear to me is that, and you see that in the quarterly numbers, that even if your domestic economy is relatively strong, and obviously the Chinese are much further ahead in terms of tackling the pandemic, as long as the global economy is not firing in all cylinders, it's very difficult for any one country to really race ahead, particularly if you're well integrated into the global supply chains. And currently, we're struggling over here in Europe, and even the US is not out of the woods yet. So it's going to be difficult for even the Chinese economy to really roar ahead.
Does it seem like one country is racing ahead with regards to a digital currency? I mean, there have already been concerns about Bitcoin holdings in Chinese hands, and now we're talking about a digital yuan that may be a potential threat to the dollar's supremacy. How do you view it?
I mean, this is a very, very complex topic, of course, and there's many, many things, including sort of international relations, but also relations between the banking system. And the way, as far as I understand, as it's designed in China, is that they're trying to sort of do a little bit of both as they integrate the financial system, the domestic financial system, that is, in order to mitigate that. Whether or not it's ultimately a threat to the dollar will depend crucially on how accepted it is also on an international basis, because it's not only the digital element that comes with it, it's certainly also the settlement technology that you can use internationally, which is currently dominated by the US dollar. So there's big questions, of course, but I think to have the answers, we will have to see what the next couple of years bring, how the adaptation will evolve.
Are we all going there, Peter? I mean, the ECB talks about a digital euro increasingly. Of course, being here in Europe, there are privacy concerns at the utmost. Will we see a digital dollar as well?
I mean, the talk is already there, and other central banks, such as the Riksbank in Sweden, for instance, they're pushing this as well, and you can clearly see also why, because going back to what I said earlier, to some degree, it eliminates that problem, for instance, with a zero bound, which for the ECB in particular might be an issue, but also it sort of it tries to stay in the game with sort of private developments, such as all the cryptocurrencies. Again, I think there's many questions that need to be answered, but the tendency towards that is fairly clear, and I mean I'm reasonably certain that at least one of the big major Western central banks is going to roll out one of those within the next 5 years.
All right, Peter, it's a fascinating topic, and we could go on this, but we have some bread and butter banks to talk about. We'll get down to those with you in just a moment. Peter Shafrick of RBC Capital Markets stays with us. Coming up, France becomes the latest country to record more than 100,000 COVID deaths as German hospitals near a breaking point. We'll talk Europe next as well in terms of the stunted vaccine rollout. This is Bloomberg.
PSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit pso.org/now, where the music plays on. PSO season sponsor, Bank of America.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Matt Miller in Berlin. Now, France has become the latest country to record more than 100,000 deaths due to COVID-19. It is a humbling moment for President Emmanuel Macron, who refused to lock down the country for a third time in January before eventually being forced to bring in more restrictions in March. Amid the pandemic, there are growing concerns among EU policymakers over the delay to the Next Generation EU Recovery Fund.
I'm deeply concerned by the delay in the implementation of the European Recovery Plan.
In the last 10 years, we must realize that we had a period of underinvestment in most European countries.
But really, what is most important is to ensure that in the future years, months and years, clearly we will be able to accompany and maintain a stable recovery.
The Recovery Fund has a vital role to play in the recovery of Europe, especially on those countries that have been badly hit by the pandemic.
We should implement swiftly the so-called Next Generation Funds, the 750 billion package. And I think that speed is still more important than weight.
It is therefore of the utmost importance that the Next Generation EU plan becomes operational without delay.
Now, all of this comes on the heels of an interview with Klaus Regling from the ESM, who insists this is all going exactly according to plan, and that speed maybe isn't the most important thing. Peter, Regling told me that the EU's stimulus or support, if you will, is going to be much better longer term, medium to longer term, than what the U.S. has done because it has longer reaching effects. Do you agree?
Well, I think that's the plan anyway. I mean, one of the things that you do see, and I think that's probably, I haven't seen the interview, what he's referring to is in the U.S., the vast majority of the current spending has been particularly on consumer support. For the European fund, it's slightly different. It has sort of a lot of medium-term investment in green technology, in digital economy, and so on and so on. So the idea is that most of these investments that shall be done are trend growth enhancing. Now, ultimately, the proof of that is going to be in the pudding, because talk is cheap, and we know that if the pressure is on to spend money, there's probably going to be quite a bit spent in let's put it mildly, things that not necessarily lift trend growth after all. So I think the idea is there. Whether that idea can be implemented in that sense remains to be seen.
I want to just break in here and bring our viewers some breaking news. Hong Kong's Jimmy Lai has been jailed for 12 months over the August 2019 protests. So we know there was a process ongoing for Jimmy Lai and for a number of other protesters, and a decision has been made in terms of the sentencing for Jimmy Lai. That is 12 months. For this trial, apparently he has 4 different trials today, so we're going to continue to follow this for you. Peter, I want to get back to you and ask about the U.S. bank earnings that we've seen. On the surface, they look fantastic, and the one problem that I can really glean, or the two, is that a lot of the gains come from releasing reserves, which you can't do forever, although they still have a ton of reserves on their books, and also the fact that there are concerns about loan growth. In terms of the economy, do we need to see big loan growth if we're going to see big gains?
Well, generally, I don't necessarily want to say that you have to see that, because in the short run, at least, a good part of the economy can also be driven by government spending and consumption alone. But what you typically do see is what you want to see is you want to see investment growing, and that typically comes on the back of loan growth. So the typical cycle would be corporations and to some degree households, particularly in the housing market, they tend to borrow and use the money that they have borrowed then to invest, and that ultimately, hopefully, is lifting the economy. So the two tend to go hand in hand together. Yes, indeed. The question is, if I may say, what is hindering loan growth? Is it a problem on the supply side, so with the banks? I doubt it. Or is it a problem with the demand? And I reckon in the current situation, it's probably more of the latter.
All right, Peter, thanks very much for joining us. Appreciate your insight this morning. Peter Shafrick is global macro strategist at RBC Capital Markets. Coming up, L'Oreal slips in the early trade as like-for-like sales in the quarter disappoint. We talk to the CEO next.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Well, it's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan. We did see some pressure on the futures. That is now being reversed.
Big banks, big bonds. From a record quarter to record debt issuance, JP Morgan sells $13 billion of bonds. Goldman Sachs follows suit with a $6 billion sale. China's economy soars by 18.3% in the first quarter, but momentum slows from the previous three-month period to almost nothing. Strong retail sales stand out as a sign of the COVID recovery from a very weak base. And the $100 million deli. David Einhorn presents the latest sign of irrational exuberance, or perhaps something else. a New Jersey delicatessen with a market cap almost 10,000 times higher than its 2020 sales. Now, let's get over to L'Oreal CEO right now from an interview earlier this morning. We spoke, Caroline Conan did, with him after earnings.
China is booming. We saw that already second half of last year, and now it's even accelerating. And it's booming on all parts, but one part is really booming. You're right. It's the Hainan Island of China. It's huge. In fact, it is becoming the #1 business for travel retail worldwide because it compensates for everything else that it's closed. And we are investing. We are opening stores. We are, of course, all our brands are there. We are investing in all means to support this business, which is really a big new opportunity.
Makeup was a category that suffered through the pandemic, with people working from home, less social occasions. As we see some countries slightly exiting their lockdowns, such as the UK, Israel, or the US, are you seeing a strong rebound in those markets?
Yes, the answer is yes. And you're right, we were really waiting for this moment to witness the recovery in makeup in all those countries where, thanks to vaccines and other measures that are going back to a normal situation. So we see that in Israel, as you say, we see that in Australia. It's coming in the UK, but in these countries, what we see is that makeup is already back to the level of almost to the level of 2019. It's not yet the fiesta that I announced, because I think that even in these countries, women are still wearing masks, and so the abandon of the mask will be the second step for the real boom.
It's not the fiesta either yet in Western Europe, where revenues actually shrunk 2.4%. Are you concerned about the prolonged lockdown, especially in countries like France, and the slow vaccination rollout?
In fact, the -2 is explained also by the fact that travel retail in Western Europe was really down during this first quarter, and we put travel retail in the results of the region. So without travel retail, if you look at just the markets themselves, in fact, it was flat. So flat is not yet, of course, the fiesta, as you say, but it's very explainable by all the measures and lockdowns that exist in Western Europe. We see it in France, we see it in Germany, we see it in many countries. But, France just announced yesterday that they will probably, stop the lockdowns in a few weeks from now, probably 4 or 5 weeks. And so I think that there is an optimism going on everywhere in Europe that what we can see today in Israel or other countries will happen also in the few weeks' time.
And that was the CEO of L'Oreal, Jean-Paul Agon, speaking to our Caroline Conan. Now, in Greenlight Capital's most recent investor letter, David Einhorn pointed out a small but strange example of what seems like evidence of a broken market. He pointed to Hometown International. It's a company, a stock with a $105 million market cap that operates just one small deli, apparently in rural New Jersey. Joining us now is Bloomberg's Danny Berger. So, Danny, what's going on with this $100 million deli?
Well, first I wanted to show us pictures of it so we could see what a multi-million-dollar deli looks like. I have to say I probably would eat here. The good news is that according to Google reviews, the cheesesteak and hoagies are excellent. Perhaps the bad news is that in sales last year, they only had $14,000. Over the past 2 years, just $26,000, despite that $105 million market cap. Einhorn in his letter also flagged that the biggest shareholder is also the CEO, CFO, a director, and the coach of the local high school wrestling team. Let me take you into my terminal so I can show you what trading in this stock actually looks like. So you can see that the market cap has risen very significantly over the past year. This is a 200% increase in the stock share price, topping out here at around $130. 13 million. Trading volume I have on the bottom, rarely does it have a day where it goes over a couple hundred shares traded. And it has a few days over here where nothing trades at all. So what exactly is going on here? I wouldn't want to speculate, but Einhorn did have some very strong words about this stock, really being emblematic of what it means for small investors, who he says get sucked into these situations, are likely to be harmed eventually, yet regulators appear to be neither present nor curious. Matt.
The interesting thing, you know, even at the beginning of that chart, Danny, this deli was worth $20 million. They must have the best breakfast sandwich in all of New Jersey. And I think one of the most fascinating aspects of this, Illustrative EV on Twitter posted that 77% of the shares are owned by firms located in Macau and Hong Kong. So it's not really just the New Jersey wrestling coach that has a stake in this.
Yeah, there are definitely other people involved. And again, you know, we don't really know exactly what's going on in this exactly. You know, in its perspective, it talks about things like advertising. It doesn't do much on social media, but, you know, it does advertise in the local high school. So it seems weird that, you know, investors in Macau would hold on to this stock. I did want to put that 105 million market cap in context. You know, in comparing it to what something like that should look like, I brought up Luby's. They are a restaurant chain. They're mostly in the South. They're in Houston, Texas, Austin, Texas, and they have a $106 million market cap. So let me take you through the differences. Hometown, one restaurant. Luby's, 125. So already that's a big difference. I already told you the hometown sales for last year. Luby's was $214 million. And this ratio, this statistic, I really love. Price to sales ratio. Luby's gets a 0.7, which is typically seen as very strong. Price to sales ratio of hometown deli, 6,728. Let me show you the final words of Einhorn, what he says about this. He says, the pastrami must be amazing, Matt.
Yeah, well, I mean, if they even have pastrami, I'm going to get somebody on the horn. This place is apparently in Paulsboro, New Jersey at 536 Mantua Avenue. I'm going to send somebody over there and taste the goods because it's got to be
the service is very good too, by the way.
Pretty incredible stuff. All right, Danny Berger, thanks very much for reporting on that $100 million deli. Coming up, BP's emissions disappear, but they don't go away. It may have sold its Alaskan unit, but the fields are producing even more emissions now than before the sale. Up next, we speak to the CEO of a sustainable investment asset manager about this kind of, is it greenwashing? We'll ask him. This is Bloomberg.
Start your mornings with Bloomberg Surveillance. Tom Keene, Jonathan Farrow, and Lisa Abramowitz. Extraordinary market day.
This rally just keeps on going.
But there is a tipping point.
The business team you love to watch. Weekday mornings on Bloomberg Television.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Matt Miller in Berlin. Now, the rise of Bitcoin has prompted the greatest push yet among central banks to develop their own digital currencies. The ECB hasn't yet decided whether it will launch a digital euro, but it talks about it a lot. The PBOC has rolled out trial issuance already of a digital yuan in cities across China. The BOJ started an experiment for its digital currency this month. What's the outlook for the digital yen? We spoke to the man in charge at the Japanese central bank.
A central bank digital currency, a so-called CBDC, is likely to become a payment option in Japan someday in the future, given that digitalization is progressing rapidly, both domestically and globally. As a central bank, we feel it's our responsibility to prepare appropriately. Having said that, we have no concrete plans to issue a CBDC, but we think there's still a need for further work on the technology side. We're looking carefully at the current technology and at more advanced technology that we might be able to use in the future. That's what our experiments starting this month are for. We're making a list of issues we'd need to solve before any future issuance of a digital currency.
So last time we spoke to you, you talked about the importance of public support for issuing digital currency. Is there any sign that public support is gathering momentum in Japan?
In order to issue a new currency, we need to work together with all parties involved. I don't believe the Bank of Japan alone can make a decision to issue a currency. Before making any decision, we would need to come up with the overall picture of the new payment system and consider how a CBDC would work in that framework. Developed countries already have efficient and safe payment systems, so digital currencies should go beyond that level, and understanding and support are needed to introduce something new.
PBOC has rolled out trial issuance of digital currencies in cities across China, and the broader rollout is expected for Winter Olympics in Beijing. U.S. Biden administration seems to view that as a potential threat. What's your view, and how BOJ does position itself in issuing digital yen globally?
I understand that many central banks have been working on CBDCs in recent years. According to a survey by the Bank for International Settlements, 86% of relevant central banks are doing some kind of work on central bank digital currencies, and many are conducting experiments. I understand that PBOC is moving fast to introduce a digital yuan. I believe technology is constantly evolving.
And that was the Bank of Japan's lead on digital currencies speaking to Bloomberg. This will be a fascinating subject, to be sure, over the development in the next couple of years. Now let's get back to BP. Emissions disappear, but they don't go away. This week we discussed how the sale of BP's Alaska unit to a privately held company may have reduced the oil majors' emissions record, but may not have made the planet any greener. In fact, the opposite might even be true. A Bloomberg Green investigation showed that since the sale of BP's Alaska assets to Hilcorp, emissions on the site have gone up more than 8%. That's an extra 500,000 tons of CO2 equivalent compared to the year before. Joining us now is Philip Zawadi, Mirova CEO, an asset manager that specializes in sustainable finance. And Philippe, you've really been a pioneer in this area. What does a case like this, and we don't have to talk specifically about BP, but a case where a large company gets rid of an asset in order to make its own, green balance sheet look better, but really it's not better for the environment in the aftermath. What does that mean to you?
I mean, this is not the only issue about oil companies. I mean, it's a more global issue, I would say. This is a part of their strategy to make a kind of window dressing of their balance sheet. But overall, the main issue is what we see about what these big oil major companies have announced these last couple of months or years. If you look at BP specifically, BP was the first oil major to announce it would become a net zero company by 2050 or sooner. So I think with the exception of the US majors, all European oil majors have also announced carbon neutrality ambitions. But when you look at the details, it becomes more difficult to assess because the scopes are not always the same. If you look at BP, for example, the net zero, it's about BP's operation on an absolute basis by 2050, but it's just the scope 1 and scope 2. That means that it's just their own operation, their own emission, the direct emissions. And we know that that the scope 3, that means the indirect emissions, are the main important for oil and gas companies. I mean, this reflects the use, that means the combustions of the fossil fuel products they sell, and which generate typically it's 10 times more CO2 emissions than the BP's own operations. So they are only committing on 10% of their impact on the climate, I would say.
You have been instrumental in policy, advising Emmanuel Macron. You've also written a book about this, Philippe, Sustainable Finance, Ringing in a Second Chance, and have really focused on the taxonomy of these issues. Will we get some kind of eco-label for investors?
I hope so. I mean, we have now the taxonomy, which is becoming, operational. And the good news is that we won't have gas into the taxonomy. There was a lot of discussion, these last couple of weeks, with a strong pressure from some countries to include gas operation into the green taxonomy. And on the other hand, you had some pressure and some push from, especially from the French government, to include nuclear. And the Commission, I think, very smartly has used this kind of different interpretation and different pushes to exclude as well gas as nuclear for the time being, and postpone the discussion on these two to the end of the year or next year. So I think it's good. So we will have the taxonomy, and then the taxonomy is a tool that we can use to build some labels, standards, and so on. So we are waiting for the eco label. The question about all these is, always the level of ambition on one hand, and not building some tools which won't be really operational on the other hand. For example, if you create an eco-label with some requirements which will be to invest more than 50% of the portfolio into taxonomy compliant assets, that probably will become very difficult to be operational on the ground, and it could lead to a label, but with very few products only, which could be be labelized at the end of the day. So all this is is on the table.
Philippe, thanks so much for joining us. Philippe Zawadi, there, the CEO of Mirova. Now let's get a Bloomberg Business Flash. For that, we go back to London and Leanne Gerrans. Leanne?
Good morning, Matt. Yesterday, JP Morgan sold $13 billion of bonds, the largest deal ever by a bank. It is taking advantage of some of the cheapest borrowing costs in years to boost its capital. The sale follows the bank's best quarter ever, with investment banking fees up 57%. And one you'll enjoy, Matt. Chinese car maker Geely says its new electric car unit, Zeekr, will give it an edge against big tech in the EV market. Its president has told us that deliveries of the new car are set to begin in September. It is targeting 50,000 annual sales by 2022 after 2 more models are added.
Zeekr is exactly created for this.
It was spun off from Geely in order to become a brand new company. No matter its brand, products, teams, organization, or its culture, which is no different from any other tech and internet companies.
全新的，成为一个全新的企业。
And that's your Bloomberg Business Flash. Matt.
Leanne, thank you very much. Leanne Gerrans there with your Business Flash. Coming up, Daimler gains after preliminary results show profit topping estimates. My interview with the CEO next. This is Bloomberg.
Asia is absolutely core to our business. It's almost 20% of our franchise revenues globally, which is significantly more than most of our global peers who are more in the mid-teens.
We want to invest, grow in China, but also we are also investing in the rest of Asia as well. Our top line growth for the region has been close to 24% last year, almost 20% of the group's revenue as a percentage of the revenue of the group. So, and this is where the group is counting on the growth.
We see company after company, these are corporates committing to net zero. So pretty much across the board, there is an enthusiasm for putting capital to work to try to get us to a better carbon future.
Credit Suisse has a fantastic brand name in Asia. We have obviously strong positions in Singapore and Hong Kong as our two main hubs, but across the region.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
The 5-year plan that Daimler signed off on just before Christmas has an R&D and capex budget of over 70 billion. And needless to say, the lion's share of that is going into new technology.
There's a snapshot of my interview with the CEO of Daimler, soon to be renamed Mercedes-Benz, which will make things, I think, a little bit easier for a lot of people. Ola Kalenia is talking to us. The shares are gaining this morning after the car maker released preliminary results for the quarter that showed a big boost in demand for its cars in China, which is a majorly important market for, well, all big automakers, but Daimler especially. Let's talk more with our senior reporter for the autos industry, Christoph Rauwald. So what do we learn from the preliminary earnings report today, Christoph?
Yeah, hi, Matt. I think the preliminary earnings show that even though many markets are still suffering restrictions due to the pandemic, that demand, especially in markets like China, as you mentioned, has been enormously strong. The deliveries are on a record level. And yeah, I think the margin development was very strong, especially at Mercedes. I mean, 14% return on sales is pretty exceptional. So it, yeah, just basically underscores a positive underlying like momentum across the sector, really.
You are focused, obviously, on the business of these car makers and their financials, but I want to, for once, get your take on the design and the desirability of the EQS. What's your opinion of this? To me, it's reminiscent of the recent CLS, and I used to call it a banana car, but I'm sure it's amazing to drive, and the range is impressive.
Yeah, Matt. I think the design has like stoked quite some interesting like conversations basically after the launch. And to be quite honest, I'm not 100% like sure if I like the exterior, but what really I think has been quite impressive is the interior of the new EQS. That's something where I think they really made a massive leap with the hyper screen and then the new tech gadgetry. That's something that I think is very strong. About the external design, I think that you can have like a pretty big debate. Yeah.
Christoph Rauwald.
This patch of land in northwest Saudi Arabia is going to become Neom, a city powered entirely by renewable energy. The government hopes the site, which is the size of Belgium, will be a clean energy hub, not only for the kingdom, but also the world.
This here is at the borderline between Mission Impossible and Suicide Mission. Lucky enough, so far we've just been on the right side of the line, yeah. But you know, it's very close to that. You know, this is just smoking. This is nothing ever I've seen or heard of the dimension, the challenge. You know, I'm not talking energy only. You know, but in its broadest context, including the geopolitical dimension, including the cultural dimension.
Neom will include a $5 billion hydrogen plant run on wind and solar energy. All of the zero-carbon fuel it produces will be shipped to international buyers in the form of ammonia. When it starts operating in 4 years' time, it will be one of the biggest hydrogen facilities in the world.
Can't explain Neom on the back of a set of PowerPoints and a video clip. You just need to be here. You need to breathe it in. Specifically the startup mode and things happening, buses all around you here.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lines in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
We're early on in this year. I know we've already sort of penciled in 6 or 7% growth and a big fall in unemployment, but under outcome-based policy, we really want to see that.
I'm bullish on the rebound, but I know we have a long way to go before the job is complete.
There's no textbook for this. You don't want to be too preemptive, but I also don't want to be so reactive that we're late.
I think it's too early to talk about changing monetary policy while we're still in the pandemic tunnel.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
The auto industry is a huge network of supply relationships and technology relationships around the world. Our guiding principle is to go for the best.
It's the basic law of economics that when things are in short supply, they tend to go up in price, and to go up in price more rapidly the shorter the supply is.
We have a group of Americans and a group of people around the world who aren't back to work yet, and we need to get that done.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua, Matt Miller, and Keely Lines.
Good morning from New York and Berlin on this Friday, April 16th. Our top stories today. Boom time for banks. JP Morgan pulls off a record $13 billion bond sale the day after reporting a blowout first quarter. Today, we'll see if Morgan Stanley can keep up pace with its Wall Street rivals. China bounces back. There's never been a first quarter with growth like this as consumers start to do their part. And shifting into top gear, the parent of Mercedes-Benz beats estimates while car sales in Europe jump 63%. I'm Keely Lines in New York with Matt Miller in Berlin. Francine Lacqua is off today. Matt, happy Friday. It has been an incredibly busy week, and of course, it's not over yet. We still have Morgan Stanley on deck later this morning.
Yeah, absolutely. Morgan Stanley rounding out the big bank earnings, and we'll get to see what loan growth is like for them. If it's like the rest of the industry, probably tepid. Also, how much they've released from their reserves. That's a good thing, but it can't go on forever. So we'll see if bank shares continue to if investors continue to be skeptical, I should say, of these bank earnings.
Yeah, that's a big question. Another thing that can't necessarily go on forever is the trading boom, because there isn't as much volatility in the markets as there was in the first quarter, really for the duration of 2020.
Very
and not
true.
a lot of volatility in markets this morning earlier. When you look, of course, at what has happened in equity markets across the world, we're coming off record highs here in the U.S., and we did see gains following on from that in the Asian session, though they weren't quite as large. We had the Hang Seng Index up by about 0.6%, the Nikkei by about 1/10, and then Chinese stocks were up by about 0.3% after that blowout GDP report from China. 18.3% growth. That was largely in line with estimates. Of course, that is due primarily to a massive base effect because you're comparing it to the first quarter of 2020 when the economy was entirely shut down due to COVID. But still, consumption coming back, that beat on retail sales, really a key thing to watch. As after that report, the dollar is basically flat against the Chinese yuan. And of course, the other story we're watching in Asia is the continued concern about the health of Huarong Asset Management. And we did see Asian dollar bond spreads widening for a 10th day in a row. As for what the picture looks like in Europe, it is green really across the screen. Anywhere you look on the continent, it is green. On Map Markets Go on the Bloomberg terminal, the DAX is up by about 0.7%, the Stock 600 by about 0.3 gains for UK equities as well. What I really want to focus, though, on a sector basis is the auto sector. The Stock 600 Auto and Parts Index is up by about 1.4%. You had that 63% jump in car sales in the month of March, plus good results out of Daimler. So that is aiding those stocks in particular. In the foreign exchange market, the pound is the big underperformer in the G10 space. Sterling weaker against the dollar by about 0.2%. It is the first day down in 5. Also paying attention to Italian BTPs, of course, those moved down about 6 basis points on the 10-year yesterday after the debt and deficit forecast out of the Italian government. Today we're moving up just about 2 basis points. As for what the picture looks like here in the U.S., again, we're coming off record highs, just softer when it comes to futures, but only down about 3 points on S&P E-minis. That as we see the Treasury market basically going nowhere. It was so curious, Matt. We had huge upside surprises on the economic data yesterday. Blowout for retail sales, better than expected initial jobless claims, and yet yields moved down 6 basis points on the 10-year. A really incredible phenomenon. Right now we are sitting sub 1.6%, sitting at 1.58% at the moment. We're going to have to break down why exactly the market is acting this way throughout the hour, Matt.
Yeah, and to me, Kaylee, I'm focused also on, S&P 4,160 feels a little bit like a roller coaster with the VIX down at 17. We're kind of slowing down, and it feels like, I'm not forecasting anything in these markets, but you could be in for a heck of a ride. I still love that story about the VIX contracts for 40 in July. Let's take a look at what's going on today that you need to pay attention to. At 8:30 a.m. New York time, Morgan Stanley releases its first quarter earnings. Then at 1 p.m., Baker Hughes releases its U.S. rig count. So those are a couple of timely things that you want to pay attention to. Going on the entire day is the Euro area finance ministers' monthly video call. And then Japanese Prime Minister Suga becomes the first foreign leader to meet Biden in person since he was inaugurated in January. They'll definitely talk about the threat that China poses. But also, Kaylee, I'm thinking they're going to talk a little bit about golf as well after that Masters victory.
I have a feeling they will. The first Japanese person, of course, Hideki Matsuyama, won the Masters over last weekend, and I'm sure that they are still celebrating that victory in Japan.
Yeah, definitely. I mean, you celebrate until next year, right? But the cool thing will be to see if he wins any more majors. And then Japanese, golf is already very popular there, but this could explode the market in a Tiger Woods way for the Japanese golf sector. Really, really one to watch.
Yeah, and we've seen a number of Japanese golf-related stocks outperforming this week off the back of that victory. So there is a market angle to this, I promise. It's not just that we're all interested in
Not as good as
golf.
delis in New Jersey, Kaylee.
True.
New Jersey delis, though. That's where the real outperformance is.
We'll have more on that later on this hour. But first, we want to talk about the mega bond offering from JP Morgan. They sold $13 billion of bonds yesterday, the largest deal ever by a bank. JP Morgan tapping the market after the Fed, of course, let pandemic exemptions over capital reserves expire. With us now is Bloomberg Wall Street reporter Sonali Basak. Sonali, is that basically what this is? No more SLR relief, so you got to raise some capital?
Yeah, they didn't say as much, but they did say that the SLR would be a major constraint moving into the end of the year, given that we don't have that same exemption, right? It's showing you just the major ramifications it's having on the banks, it's having on the bond markets, and it's having on the banks, especially as those deposits keep flowing in while lending remains somewhat constrained, they say, due to demand. How much more do we see JP Morgan and others really fighting the government on this? There's plenty of people out there who are counting for relief.
Sonali, is Morgan Stanley going to be a Goldman Sachs rather than a JP Morgan? Is Morgan Stanley going to be a Goldman Sachs rather than a Wells Fargo?
Yeah, that's the real hope here, because you don't have these massive lending books at Morgan Stanley like the others. However, when you look at the estimates from Wall Street right now, their estimates are somewhat more tepid than what we had seen from Goldman Sachs. So just under $3 billion, $2.5 billion of equity sales. That's really what we're watching for, sales and trading. They are the number one equities trading shop on Wall Street.
Right.
What did their market share look like in such a standout quarter? Just over $2 billion worth of FIP. Yep. I also looked at the league tables for you, Matt, because, it's kind of an indicator of future looking. Yeah, MA Go. You have Morgan Stanley right now standing at number 3 behind Goldman and JP Morgan. Usually the last couple of years they've been fighting really hard to get that number 1 spot. What does their pipeline look like? Right now, the estimate is for almost half of what Goldman is making in advisory revenue. So can they make that business more competitive? In equity underwriting, they're right behind Goldman Sachs. So let's see what that translates like right into revenue.
All right, Sonali, you're going to sleep all weekend, right? You've been awake literally all week covering these banks, and we appreciate it, as well as the Coinbase direct listing. Sonali Basak has gotten 0 sleep, so she's going to make it a solid 48 hours. We've had a lot of data out of China with the economy soaring by a record in the first quarter, but that's really due to the base effects from the pandemic slump. And when you strip those out, or when you look at month-over-month data, it doesn't look quite as impressive. Joining us now is Bloomberg Chief Asia Economics Correspondent Enda Curran. So, Enda, what do we see here?
Well, Matt, look, it's like you mentioned, there's no doubt on a headline basis, China is continuing to enjoy a V-shaped recovery. We saw that record on-year growth of over 18% in the quarter. And interestingly, we saw a pickup in retail sales spending in the month of March. That's all important. That's what a lot of people have been looking for, when consumers might gain traction. It looks like now that's finally starting to happen. And it's important because the virus has been under control for so long in China. It's been kind of a missing part of the jigsaw, so to speak. But nonetheless, like you say, at the same time, when you step away from that, actually quarter-on-quarter growth slowed down in China. It slowed from over 3% to 0.6%. And there's still softness in sectors such as the services side of things. Domestic travel is under pressure there still due to restrictions, and the jobs market, even though the jobless rate fell, such as the unemployment rate is in China, it fell. The Stats Bureau spoke about weakness in youth employment, for example. This has been a theme that we've been watching over the past year or so since the pandemic began. So, look, no doubt, China's recovery is on track. It's still a V-shaped rebound from where we were a year ago. But as you mentioned, it's uneven, lopsided, and certainly pockets of the economy where there's still plenty of softness.
Yeah, that's absolutely right. And the other story we're watching out of China is the evolution of this Huarong asset management saga. Chinese financial regulators said operations at the country's bad loan banks are stable. So that seems to be somewhat of a vote of confidence. But what is the latest on this?
Yeah, so obviously there's been something of a void on this story over the past week or so, and that's left the market to, of course, run down the prices on Huarong bonds and cause jitters beyond. But now we're getting some signals out of Beijing, the first being that Huarong is going to pay the first bond that's due, it's going to repay that. And then secondly, we've had those comments actually just out of Beijing before I came on from one of the regulators. He seems to be sending some soothing music that the regulators are on top of this, and that they seem to be somewhat in control of where Huarong is headed. But there's still a lot of questions on all of this. There's still a lot of outstanding dollar debt due for Huarong this year. There's still a lot of unknowns. And in particular, will there be a restructuring, not just of the company ownership, but even of those bonds that it does owe on the public market? So no doubt that we're starting to get some signals now from Beijing for the first time with this saga, but I think there's still plenty of uncertainty and question marks over where this all goes next.
Yeah, a lot of question marks. Bloomberg's chief Asia economics correspondent, Enda Curran, thank you so much. I do want to take a look at some stocks moving in pre-market trading now. One of the big outperformers is DraftKings. It's up the better part of 5% in early hours after news it will become an official sports betting partner of the NFL. Nice lift for the shares there. A nice lift as well for CureVac, up about 3.3% in pre-market trading, set for its 5th day of gains in a row. The company's COVID-19 vaccine could be seeing more demand if it is approved, considering the pause of the J&J shot. And of course, Matt spoke to the CureVac CEO earlier on this morning. Also, two stocks I wanted to pay attention to, both debuted this week. One is Too Simple. It's a self-driving auto tech company. It literally closed at its IPO price of $40 yesterday. Its trading debut today. It's trading just below that at $39.46. And then, of course, Coinbase. Talk about a volatile debut. It is actually now looking like it could open down for a third day, down 3 days in a row after its debut, which of course had all the hype around it, Matt.
Yeah, it was up to 429 and change, and now it's trading down to 322 just 2 days later. It was massively hyped. I was super pumped for that IPO.
So was I.
And for that direct listing. Yeah, because of the direct listing aspect of it, I thought it was so cool. Those investors didn't leave anything on the table for sure. Coming up, John Bilton, JP Morgan Asset Management Head of Global Multi-Asset Strategy, joins us. Then later we're going to speak with Banu Baweja, UBS Investment Bank Chief Strategist on emerging markets, really on China. This is Bloomberg.
Minority myth wasn't something that was fabricated by the Asian Americans. It was created as a tool to alienate the Black and the Asian American communities, and it was incredibly successful.
We know the racism didn't begin yesterday.
We know it's probably not going to end tomorrow, but it is our job to make sure that there's progress and we keep people safe and give people dignity.
I spent a lot of time last year to just listen, to understand, to reflect and understand what I could do as a leader of this organization.
For many years, we've been very shareholder focused, and now there really is much more of a community requirement.
The economic downturn in the US, we're seeing unemployment and income losses affecting women more than men.
2/3 of the jobs lost in South Africa were women's jobs. So I think we're in a moment of crisis.
Clearly, our societies are reproducing, not producing inequality.
We need better public policy and we need companies to step up.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in Berlin with Kaylee Lines in New York. Francine Lacqua is off today. Kaylee, we've been talking about the big gains you saw in Chinese GDP growth, but that's only because of the base effects that really amplify it if you look at it year over year. I've got a chart that shows the amplification, and it's pretty amazing. If you look back to the same quarter in 2020, I'll say for our viewers on radio joining us on London DAB, there's a big dip below the zero line, a huge dip. It looks like 7.5%. That's why this quarter is such a huge jump, 18.3%. If you took that out, or if you looked at it just month over month, Kaylee, it would only be 0.6%. So not much of a gain really at all. Joining us is John Bilton, JP Morgan Asset Management, Head of Global Multi-Asset Strategy. John, let me first get your take on Chinese growth. We knew the base effects would be there, but do you still expect China to be one of the main engines for global growth this year?
Well, I mean, as the second largest economy on the planet, by definition, if China is growing, the global economy is going to get some support. I mean, I think, base effects matter everywhere. They're going to matter a great deal as we go through the next couple of quarters. And, I think that China is definitely slowing in its pace of growth, but I stress the word growth. China's GDP, if you look at it in index terms, is actually well above its pre-COVID recession level. And what that means is China's economy has now actually expanded beyond where it was. The rest of the globe, we think, will take somewhere during the second half of this year to get back to pre-pandemic levels. So while China certainly has done the early running and is now probably moderating a little bit, I think what's great when we look at the global economy is actually we've now got some really powerful economic growth coming through in that other major global growth driver, which is the United States, off the back of the stimulus. So I would certainly not be throwing the towel in on very strong above-trend global growth this year.
John, picking up right where you left it with U.S. growth, we continue to get upside surprises on economic data. We saw that with a blowout retail sales number yesterday. And the Treasury market reacts in exactly the opposite way you would logically think it would. Why are bond yields in the 10-year Treasury sub 1.6% given that growth story you were just speaking about?
Well, it's amazing how sometimes we have a short memory in the markets. Let's take a look at the facts. The first quarter of this year, bonds had their worst quarter since the fourth quarter of 2016, the seventh worst quarter in the last 30 years as we repriced growth. And what's happened now, I think, is we're at a level where we've got much more of the trade-off between positive growth and a dovish Federal Reserve in the price of bond markets. Also, what's crucial at these levels, at the sort of 1.5 16, 17 in the US 10s, you get a lot more two-way demand. You get demand from those de-risking portfolios, and with S&P at 4160, 11% up on the year, the temptation to move some of that money off the table and buy bonds to hedge longer-term liabilities is actually quite compelling. And so I think what we're entering now is a period where bond markets are well balanced against the external forces of growth and policy, but also reflecting much more two-way risk in the duration market.
John, would you buy 31-year debt yielding 107 basis points over treasuries? That's part of what JP Morgan is selling.
Yeah, as you know, I can't really comment on that specifically, but I think that what we are seeing generally across duration markets, across credit markets, is continued demand. What it doesn't mean is that we won't see riskless rates rise further from here. What we think that we're seeing, though, and we saw this in the past couple of days with how the Treasury market responded to very strong data, is that pathway is going to be a bit more measured, maybe a little bit more choppy in places, but by and large, as growth comes through, we do think that those yields will go up. And as yields rise, you will bring in more and more natural buyers of bonds, both from hedging purposes, but also from carry and from investment purposes as well.
Well, of course, John, that bond sale from JP Morgan followed earnings from JP Morgan that were a blowout, not necessarily rewarded by the market. How much of the good news do you think is already priced in? Are you worried that sentiment maybe got ahead too far?
Well, again, moving away from any specific individual firms, one of the things that I would look to is the fact that we've got base effects to come through in earnings as well. We are expecting upwards of sort of 30% earnings growth over the course of this year across the corporate base. We've seen, a little bit of an upgrade cycle coming into earnings this year, but what we've seen across the financial space, and bear in mind we're very early in the earnings season so far, is reasonably solid numbers across that sector. And I think that that's something which augurs well for the reopening of the US economy. Because, bear in mind at the moment, when we look at the services sector, it's only really just beginning to get back onto its feet. So we're actually rather positive looking forward to earnings, and bearing in mind that with the stimulus that was announced, there's a lot of money in people's pockets, and we saw that in the retail sales, and we think that will come through in earnings.
John, sorry, I just got to break in here. And, well, first of all, thank you very much for joining us. John Bilton, JP Morgan Asset Management Head of Global Multi-Asset Strategy. I'm just going to jump in because we're getting a headline across, Kaylee, from China's CBIRC saying Huarong's operational levels are normal and that Huarong's liquidity is ample. So there's been a lot of concern about a possible default on this debt. Yesterday, we got a headline saying they're going to make the closest payment to April 27th. And they're also looking at bonds that are trading at only 51 cents on the dollar. But the CBIRC in China is saying that their liquidity is ample. This is Bloomberg.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Our goal is to produce 300 million dosages in 2021 within our network. And then you have to see how many of these dosages can be released, because there is a release process, which is certainly to be accelerated then there as well. And for 2022, we are planning to produce 1 billion doses.
That was the CEO of CureVac, Franz Werner Haas, coming to us from my alma mater of Tübingen, Germany. More on that interview throughout the day. And Banu Bueja coming up, UBS Investment Bank Chief Strategist, on what's going on in China.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
trading revenues coming in better than expected, everything. Cash, $1.4 trillion of cash, one of the most notable aspects of this report that was stellar.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons in New York with Matt Miller in Berlin. Francine Lacqua is off today. We made it, Matt, an entire week without Francine, but of course she will be back on Monday, and she certainly missed a lot, and we'll miss more today.
Yeah, there was so much going on. I mean, the bank earnings were incredible. Some of them coming a little bit early. Then we had the Coinbase IPO, which took, well, direct listing, which felt like it took forever because it was a direct listing, which I think we both thought was so exciting. But now we're seeing a drop in these shares, and I wonder what it means for everyone, all the retail investors who got in on Wednesday.
Well, yeah, I read an interesting stat yesterday that something like 20% of all retail dollars that went into the Coinbase stock happened in the first 20 minutes of trading. It was some insane metric like that. I will try and find it and bring it to all of us. But I do want to get a check on the markets. Bitcoin is included in this market check, and that is related to Coinbase. We are seeing equities picking up on both sides of the Atlantic. After the European Open, and we watched the stock 600 climb to now be up about 0.5%. Futures came up off their lows as well. We are now actually flat on the S&P 500 E-mini futures after a record high yesterday. So we will see if these gains can continue. We are basically flat on the 10-year yield as well after a monster bid into the bond market off the back of stronger than expected economic data yesterday. It's a very interesting dynamic question of how much of that growth maybe was already priced in by the market after that huge sell-off that we saw in the first quarter. And then Bitcoin, Matt, here it is for you, down 4%. We're sub $61,000 once again, so more than $3,000 off the record high we saw earlier this week. That is weighing on some stocks tied to cryptocurrency in pre-market trading. One of them, Bit Digital, it's a Bitcoin miner. It's down 8.3% before the bell. Riot Blockchain, Marathon Digital Holdings, each down around 7-8%. And then, of course, there's Coinbase, down 0.6%. It fell on its debut day. It actually ended up falling yesterday, even though it had gains early on, and once again pointing lower ahead of the opening bell in about 4 hours' time, Matt.
It'll be interesting to see if the retail investors that bought in the first 20 minutes of trading actually have the diamond hands necessary to hold this share price above 320, Kaylee. I want to take a look at a chart on China, though. We've been talking about China all morning. The numbers in terms of GDP growth were pretty phenomenal when you look at them year over year, but that's because of the base effects. 2020 was a very weak year because of the pandemic. This chart shows just exactly how weak. It was the first time in 40 years, this chart goes all the way back to really the 70s, that we saw consumption drag on overall growth. For those listening on radio, this chart splits up net exports, consumption, and investments with their effects on GDP. Consumption has, as long as this goes back to 1975, 76, it looks like, we've never had consumption drag on Chinese GDP growth. Now they need to get it back, and we're going to ask Banu Baweja if they will. He joins us right now as UBS Investment Bank Chief Strategist. How do things look to you in China? Obviously, the base effects were horrendous, which we just showed. Is there going to be a robust bounce back in consumption?
I think there is. You're going to see consumption moving up and potentially investment, particularly property investment, slowing down a little bit. I think along with the GDP data, you also saw the release of partial numbers of economic data. And there you saw a microcosm of what we're likely to see in GDP moving ahead. We saw industrial production slowing down, and we saw retail sales picking up. So that's the kind of rotation within China between different parts of the economy that we're likely to see. That's not a problem for China, because China will still see about 8% growth this year, 8 to 9% growth this year. But it is a modest problem for the rest of the world, right? Because we have to understand that when China invests, it demands much more from the rest of the global economy, and therefore influences earnings in Europe, in Australia, in emerging markets to a much larger degree than it does when it consumes. So as these levers shift away from production, manufacturing / investment towards consumption, Chinese GDP and Chinese markets don't see a major impact, but the rest of the world, including on inflation expectations, does see a little bit of a dampening effect.
Does that then import deflation? Is that what you're saying?
What I am saying, Matt, is that most of investors have basically focused on U.S. fiscal as the fulcrum of the inflation narrative. And I don't think you can have a conversation about global inflation, whether or not we're going to see a regime shift in global inflation, without having a conversation about the single largest contributor to global growth, which is China. And China had to use a bullet, which they didn't necessarily want to use last year, in terms of stimulating the housing market very aggressively. That's the fourth time within 10 years that they've had to do that. Moving forward, if China gives you less stimulus, which is already happening, by the way, the March credit figures, which I think were actually more important than the GDP figures, showed a slowdown in China credit, and the credit impulse is going to turn negative in May. So I think that will impart disinflationary impacts, particularly on commodity prices, which is relevant for inflation expectations.
And what is the fact the PBOC obviously is tightening in a way that other, Western central banks aren't? What clues are we getting from China about what happens when the tap starts to turn off?
Yeah, I mean, to be fair, the tightening thus far is very limited. You've seen tightening, particularly in shadow financing. You've seen regulations, particularly of internet companies, antitrust regulations, and you've seen government bonds and corporate bonds issuance reducing a little bit out here. But I think you will begin to see this in terms of housing starts and property investment slowing down, which frankly it hasn't so far. So thus far this year, they have been speaking about tightening since H2 of 2020, but till March, you really didn't see a significant slowdown in property investment. Once that turns, I think you will begin to see that reflected in commodity prices, iron ore, potentially also copper. And I think that will change sentiment on inflation expectations in the developed market as well. You cannot divorce what happens to inflation expectations, and therefore the value rotation, the small cap rotation across the world, from what happens to commodity prices. So watching China, particularly property investment, I think is extremely important.
Yeah, it's very interesting. And you mentioned credit markets there, and I want to get your take on the Wa Rong situation. We got a headline out just about 20 minutes ago saying China says its operations are normal, liquidity is ample. But what does that situation mean, all of this concern around a state-backed, state-owned entity and the potential that the Chinese government wasn't going to be there to bail it out if needed? Does that affect your investment thesis when it comes to Chinese assets?
I wouldn't think so. I don't think the Chinese government is likely to allow this to become systemic. But every time China pulls back on credit, and when I say pulls back on credit, let me remind you, I'm not talking about deleveraging. I'm just saying levering up at a much slower pace. Instead of 35% increment per annum as a percentage of GDP, you go to 20% increment of TSF as a percentage of GDP. You always see a pickup in defaults. I think we should be prepared for that. And as these defaults come through, you will see the reaction function of the PBOC, or the reaction function, I should say, of the State Council. They are trying to induce moral hazard within the market selectively. So I don't think that completely changes the thesis. I think we should fully expect higher defaults and some surprises on the change in the reaction function.
You're great at a 35,000-foot view, Banu. You're really good at picturing things longer term. How do digital currencies change the way you look at the world? It's been talked about as the digital yuan as a threat to the U.S. dollar. Our own Mike McGlone has pointed out that Bitcoin has been a real support to the U.S. dollar. How do you view digital currencies in the changing landscape of central bank financing?
I think central banks will slowly move towards digital currencies themselves. So these currencies are going to take digital form. But I'm not sure at all that this is going to become, other new currencies are going to become fiat money to the extent that they replace globally established currencies like the dollar and the euro. I wouldn't put the renminbi in that category just yet. I mean, it's not international money in the same way as the dollar and the euro are. I think central banks themselves are likely to digitize more transactions, and therefore the dollar is likely to get more and more digitized. These transactions are likely to get digitized. you will have some transactions continuing in things like Bitcoin and other currencies, other cryptocurrencies. But I think we need to make a distinction between cryptocurrencies on the one hand and digitization of currencies on the other. I think you will see central bank currencies, fiat currency that we see today, becoming a larger part of the digital universe. That's the future, as opposed to cryptocurrencies taking over as fiat money across the world.
Banu, thanks very much for joining us. Always appreciate your insight on this program. Banu Bueja is UBS Investment Bank's chief strategist. Coming up, Daimler profits topping estimates as car sales surge in Europe. More from our interview with the CEO of Daimler, soon to be Mercedes-Benz, Ola Källenius, next. This is Bloomberg.
Particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
The 5-year plan that Daimler signed off on just before Christmas has an R&D and capex budget of over 70 billion, and needless to say, the lion's share of that is going into new technology.
That was Daimler CEO Ola Källenius speaking to me yesterday. Auto sales in Europe soared. We got those numbers for last month this morning, erasing an early decline. So the auto industry, and Daimler especially, really on a strong track right now. I want to bring you, before we get further into that, some breaking news on Jimmy Lai. He has been given an 8-month jail term for another 2019 protest. We told you earlier this morning that he was given a 12-month jail term for a 2019 protest. There were 4 separate cases for Jimmy Lai to stand in today, and it looks like there are a number of different sentences coming out. So we've gotten a 12-month sentence earlier. We just got another 8-month sentence, and somehow that totals 14 months. The math doesn't add up in my mind, but I'm not taking Tom Keene's calculus class, so I'm not 100% sure how this works out. In any case, Jimmy Lai has has more trials to go today, and a lot to stand for in Hong Kong, and we're going to continue to bring you the details when this all gets cleared up. As My boss is telling me right now on email, sometimes sentences run concurrently, and that's a very strong point, KB. All right, let's get to Chris Ralvald now, our senior autos reporter, coming to us out of Frankfurt. Chris, we just got Daimler releasing numbers very early this morning, like 1 a.m. local time in Stuttgart. But really, the market is very impressed. Why did they do so well?
I think the main reason was the strong demand that we've seen in China. Demand there bounced back very strongly after the pandemic. And that really is a market that's very profitable for them. It's the biggest sales region for the high margin models like the S-Class sedan, which they are just launched like a new version of, and the big SUVs. So that's really pushing up the profits there.
Well, it's a great point about the shift toward higher margin vehicles, and a large part that has to do with the semiconductor shortage that automakers really around the world are facing. How big of a headwind is that going to be for Daimler going forward into quarters to come? And especially also when it comes to sales, because we had, blowout numbers for the month of March, but if there isn't enough production to meet demand, what is that going to mean for sales numbers going forward?
Yeah, that's a very good question, and that's actually one of the points that investors are looking at very, very closely, because the supply bottlenecks for semiconductor chips is dragging on for quite some weeks now, and it's affecting production. At Daimler in the first quarter, it actually had a positive effect on the margins because of the limited amount of chips they have available that prioritize the higher margin cars, which pushes up the return on sales. Down the line, this is, of course, like a big headwind, because at some point there might not be enough chips around or available, so that they potentially have to cut down production like deeper, and that's obviously in the longer run really bad for earnings potentially.
Yeah, absolutely. All right, thank you so much to Bloomberg's Chris Ralvald for joining us today. And coming up, we'll have part of our interview with Bank of America Chairman and CEO Brian Moynihan. That's next. This is Bloomberg.
isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
We don't think we have all the answers at all. We immediately say, could that have happened here? How do we know it didn't happen here? Let's go double check. Let's recheck all our systems and make sure, et cetera. Cybersecurity attack, whatever the case is. And that, so one of the ways you have to, you have to be curious. You have to ask the question. If you think, whether it's even on the competitive side, new products, new services, what's out there, what do customers need, you have to be curious, but also on the risk side. And Jeff Green, our Chief Risk Officer, along with Tom and Jimmy DeMar and the team in the lending side, a fellow named Robert Schleicher and Bruce Thompson and Mick Ankrum, these guys, this team and Cheryl Boucher, and this team is just very good at understanding risk. And so sometimes the opportunity is that you take it, sometimes you don't. But whenever anything happens, you've got to go in and look and say, okay, let's not act like we're too smart. Let's not think we're too smart. Let's doubt. Let's have serious doubt about how good we are and go look at it and confirm that it didn't happen instead of saying it couldn't have happened because. And that's the way you run good risk management.
You had an extraordinary experience at Bank of America. Others did as well, where you had to go to work from home almost overnight with an awful lot of employees. You gave a lot of support to those employees. Is it necessary to bring them all back? And if so, do you need to give more support in that process?
We're letting people make their decisions. We're encouraging them. We're showing them lots of data. We're trying to get appointments for our team and things like that so they can get back to work. And then we're a work from office company. Now, we are already in the mode of high-performing workplaces and sort of hoteling office and all the different discussion. We think people will think about commuting differently. I always tell the story that we had, our big buildings in Midtown at One Bryant Park, and we're doing a building across the street. And when we ask people to move to Jersey City or something like that, they might, or Hopewell, they might think, oh my gosh, you're sending me to Outer Mongolia or something like that. The reality is they now have gone from home and they're much more adaptable. Well, I'll commute in the city a couple of days. I'll commute, to Jersey City, or I'll go to Hopewell. So we have to think about our real estate configuration and retool it. In the end of the day, 10 years ago, we had 130 million square feet of real estate for Bank of America. Today, we have about 70. And so we can just keep making that real estate more efficient and more dedicated team, better real estate for our teammates to work in, and then work with them on their personal decisions. But at the end of the day, we have found in our work from office strategies, or work from home strategies, which we've had for years, that certain types of jobs and certain types of activity are better served. And we have about 20,000 people working from home before the pandemic, but it has to be a certain type of job and a certain activity, and we'll see how that plays out. But my big expectation is after Labor Day, we'll be back to generally moving towards being back to normal. Between now and then, it'll be partial. But the key is, then you flip it for the good of cities and towns and stuff. As those people who are vaccinated come back to work and go to restaurants, that'll just be good for the vibrancy of downtown. So in Charlotte, I was talking to another CEO today. We need to get the people commuting downtown, and then the restaurants and downtown life can come back. And great cities need that.
Bank of America Chairman and CEO Brian Moynihan there, speaking with our own David Weston. For more of that interview, catch Wall Street Week tonight at 6 p.m. New York time. Now, in Greenlight Capital's most recent investor letter, David Einhorn pointed out a small but strange example of what he sees as evidence of a broken market. He pointed to Hometown International. It's a company with a stock valued at $105 million that operates just one small deli in rural New Jersey. Joining us to talk more about this is Bloomberg's Danny Berger. So, Danny, what exactly is going on with this little restaurant?
Well, first I wanted to show us pictures of this little restaurant so we could get an idea of what this multi-million-dollar deli looks like. Very homely, kind of what you would expect from a rural-type deli. According to the Google reviews, I hear that their pastrami and cheesesteak is excellent and that the service is really good, too. That's probably the good news, but the bad news here, and the real mystery with this, is, of course, the market cap. And David Einhorn in his letter also points out that one of the biggest shareholders is also the CEO, the CFO, a director, and the wrestling coach of the local high school that's nearby. So let's check out the trading of this thing.
Danny,
it rallied to
Danny, let me just jump in and for our listeners on radio, you scrolled through some pictures there that they clearly couldn't see. but just to describe it looks like, I don't know, it looks like really a small town deli. There's nothing fancy in there. You've got your bottles of condiments out that you choose, a box of napkins, a box of plastic silverware, and what looks like plastic tablecloths and fold-up metal chairs. So it doesn't make sense that this is a more than $100 million valuation for this little deli.
One of my favorite details I think you left out was the tablecloths on there, all very clashy, just absolutely kitschy. I really love it, but again, that doesn't mean it's worth $105 million worth of market cap. And that market cap has surged this year. The stock price has gone up 200% in the past year, and the daily trading rarely goes above a couple hundred shares, which of course means that this price moves very volatile. And Matt, you and I were talking about this earlier. If you dive into the filings of this company, you can see that its biggest shareholders are also located in Hong Kong and Macau. Again, a very strange thing for a very rural-looking deli. Einhorn basically saying, look, this is an example of something weird going on. He didn't speculate what it was. We're not going to either, but saying that small investors who get sucked into these situations are likely to be harmed eventually, yet the regulators appear to be neither present nor curious.
Danny, can you just put $105 million of market cap into context for us?
Yeah, absolutely. So the best way I think to do this is to look at another restaurant company, Luby's. They're in the South. They have a bunch of chain franchises. They have 125 stores. They have over $200 million in sales last year, 14,000 for Hometown. Their price to sales ratio, a healthy 0.7. Price to sales for Hometown, over 6,000. In the words of David Einhorn, the pastrami must be amazing.
Must be.
Wow, it is a really fascinating story. Danny Berger, thanks very much for that. Kaylee, you know, I think one of the most interesting things is that this deli actually exists somewhere in New Jersey. We could send a reporter. You could get in a car and drive out there and get a sandwich.
I just Google mapped it on my phone. It's an hour and 49 minutes away, Matt. So maybe I know what I'm doing this weekend. We'll see. All right, that wraps up for me and Matt. Francine will be back on Monday. Thanks for joining us. This is Bloomberg.
Asia is absolutely core to our business. It's almost 20% of our franchise revenues globally, which is significantly more than most of our global peers who are more in the mid-teens.
We want to invest, grow in China, but also we are also investing in the rest of Asia as well. Our top line growth for the region has been close to 24% last year, almost 20% of the group's revenue as a percentage of the revenue of the group. So, and this is where the group is counting on the growth.
We see company after company, these are corporates committing to net zero. So pretty much across the board, there is an enthusiasm for putting capital to work to try to get us to a better carbon future.
Credit Suisse has a fantastic brand name in Asia. We have obviously strong positions in Singapore and Hong Kong as our two main hubs, but across the region.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Consumer is, once they're in a sense let loose, they're going to start spending.
Going forward, what's going to power consumer spending is the services side of the economy, not the goods side.
Everything we follow would suggest every bit of inflation is being passed through and then some.
The market overly priced for that inflation risk in the near term. We're still going to have higher inflation to come.
Powell has already made it very clear what they intend to do. They're not doing anything.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Is this as good as it gets? From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance alongside Lisa Abramowitz. I'm Jonathan Ferro. Tom Keene taking an early weekend, Lisa. Equity futures up 0.1% on the S&P 500. This week, confirmation that things are getting better.
Yeah, Tom Keene taking some time off to talk about and think about his triple leverage cash fund position, given some of the dynamism that we've seen in the economy. The question that you asked, though, John, is this as good as it gets, is really the key question underpinning why bond yields are so low, why they are going lower as we do get these blowout numbers and as we get this sense of optimism and reopening around the world.
Retail sales, reserve releases at banks, the numbers are just fantastic. Consumers flush with cash. Lisa, have we ever started a recovery this way? And I think that was the commentary we got from the banks this week. We really haven't seen a consumer come out of a downturn in the shape they're in right now, at least at the aggregate level. I don't think for a long, long time, if ever before.
I love how they try to paint the idea of low consumer loan demand. They basically were saying this is a good thing, not a bad thing, after JP Morgan's Jamie Dimon came out and said that something that was a little bit more negative. Then he was saying it's good to have an under-leveraged consumer. This actually will give power to spending. But this really is a key question. Will that loan demand continue? Will it pick up? Or is this as good as it gets? Will people use the cash and then sit on their hands as they wait for something better?
It's good for the economy. It's not great for them. Morgan Stanley coming up a little bit later. That won't be a Morgan Stanley story. We'll be talking about a massive quarter for the quarterback for the investment bank over at Goldman Sachs and what that could mean for Morgan Stanley at around about 7:30 Eastern time. Though bear in mind, I think Goldman was a little bit early, and I think Bank of America was also a little bit earlier this week as well. So look out for those numbers a little bit later this morning. Let's run through the price action. This is what it looks like this Friday to close out the week. Shaping up as follows on the equity market. A push higher on the S&P 500, up by around about 2 or 3 points. We advance 0.1% and heading for a fourth straight week of gains. Into the bond market, yields unmoved, unchanged, 157.45 on 10s. And in the FX market, Lisa, euro dollar, a push higher again by 0.1%. Euro dollar 119.78.
Yeah, and this really goes to a positioning story, both with respect to the strong dollar. Has that gone as far as it can get, as well as the weaker bond market, the lower yields, or the higher yields, the lower the price? Has that also gotten worked out? And are we seeing a short squeeze? And that's one of the questions underpinning some of the market moves. As you said, 7:30 a.m. is when we expect Morgan Stanley first quarter earnings, although they could come at perhaps, I don't know, 6:30 if we get any sort of precedent from Bank of America. The expectation will be for, as you said, a blowout capital markets quarter. Key question, though, will be going forward, how did their acquisitions of E-Trade, of Eaton Vance, really play into their fundamental structure, their profitability? What does this mean for other banks looking for acquisitions? Then at 8:30 a.m., we get some housing data with respect to building permits and housing starts. Interesting to see how much optimism there is in building new construction at a time of such high lumber costs and rising prices, which cap potential demand for some of the first home buyers that really need to come back into the market to really suck up some of the inventory that people are expecting to come on, although not a lot of inventory out there right now. And today, I'm going to be really watching this. President Biden hosting his first major meeting with a major leader of a nation, and that is, of course, Prime Minister Yoshihide Suga of Japan coming to the White House. They're going to be talking about Taiwan. They're going to be talking about what their strategy is toward China. Very interesting to see what they get on the same page with and how contentious the issue in the South Sea really becomes, John.
They've got to talk about Matsuyama as well. A shout out to the Masters champion in the last week. Lisa, thank you. The big story in the last week, I think, for many people in this market is what happened with CPI and what didn't happen in the bond market, what happened with retail sales and what didn't happen in the bond market. CPI coming in a little bit hotter than the median estimate, bonds rallied. Retail sales coming in with a huge upside surprise, bonds rallied. And Lisa, that's got to define the moment we're in right now. For this equity market, it's been buy the rumor and buy the fact, apparently. And for this bond market, it's been sell the rumor and buy the news.
Honestly, yesterday's move didn't make a lot of sense from any fundamental basis, right? I mean, if you get better than expected retail sales, you see the recovery beginning, you see this ongoing vaccination effort in the United States, why did bond yields fall so much? Why was there a big rally? And people are pointing to technical issues. I'll also point to the Fed. You know how what I do every Thursday at 4:30 p.m. I take a look at the Fed's balance sheet, and it grew to a new record of near $7.8 trillion, growing by $84 billion in the month. There is a question, or in the week rather, is this really what's underpinning the move?
If Tom Keane was here, he would tell you to get a life. 4:30.
Which is not at all what you're thinking
Looking
whatsoever.
at the balance sheet, no, not at all.
It's transitory.
Not at all. Mickey Levy joining us now, Berenberg Capital Markets Chief Economist for US, Americas and Asia. Mickey, let's just start right there. Inflation coming in a little bit hotter, bonds rallied. Retail sales coming in a little bit better, a whole lot better, bonds rallied. You think this inflation story can be more persistent than other people think? Why, Mickey?
I do believe it's going to be more persistent. Okay, so no question, the CPI, we have a base effect and higher oil prices going through to the retail level. But we all know the economy is reopening. If following the reopening, there is continued strength in aggregate demand, which I expect based on all the monetary and fiscal stimulus, we've never seen anything like it, then businesses will have the flexibility to raise product prices, which we're beginning to see, and the inflation is going to rise modestly. I think there's no question at all. Now, I listened to your opening remarks. I think too many people, including the Fed, are looking back to post-financial crisis and say, oh, we're going to have the same pattern this time. Well, if you look at monetary policy, fiscal policy, the consumer, banking, or almost any other industry, including housing, it's a 180-degree opposite of what happened post-financial crisis. And I think the Fed is overly sanguine that inflation is going to stay at 2%. There is no question it's going to rise. And as we speak, we see businesses experiencing much higher operating costs, and they're announcing product price increases in order to maintain their margins. So it's an obvious trend.
On top of that, Mickey, you've got a policymaker conditioned by the last cycle for a cycle that's got not much in common with the previous cycle. I just wonder how much of a risk you think that is.
That it is a risk, particularly because our policymakers, both in the administration and the Fed, are operating as if it's very similar to following the financial crisis. Now, keep in mind, back then, there was modest fiscal stimulus. There was a whole lot of zero interest rates and QE by the Fed. But back then, all of that increase in bank reserves stayed as excess reserves. It never got into the economy. It never got out of financial markets. So it didn't stimulate the economy. Well, okay, this time around, you've seen not only a huge increase in bank reserves, but M2, that is bank deposits, are trillions higher. It's ready to be spent, and now we're seeing it being spent. So you're going to get the excess demand that once again allows businesses to raise product prices, and you're going to see higher inflation. And the Fed's going to be caught by surprise because it's really following the wrong model. It's really
wait, hold on a second. It's following the wrong model. What model should it be following?
We should be following basic economics and what history tells us. The last decade is only 10 years of history. If you go back through history, and my co-author Mike Bordeaux and myself have written a paper on the history of deficits and inflation, and it's clear that with all this deficit spending that has dramatically increased household disposable incomes and saving, and the monetary stimulus, you're going to get a significant amount of excess demand in the economy. By excess demand, you saw retail sales. And in the next couple months, as the economy recovers, there's going to be more of that. But then beyond the initial stage of the services sector coming back and consumption of durables continuing and housing doing extraordinarily well, you're going to see a continued economic strength, because that's what any macro model would tell you. And the Fed is just still relying on, oh, look at what happened when we did QE2 and QE3. It didn't have much of an impact.
Right. Mickey, let's put some numbers on this. I mean, you're talking about really the big question, which is what happens beyond the first couple of years as we emerge from the pandemic. Right now, five-year break-even rates, basically the expectations for inflation over the next 5 to 10 years, is around 2.2%, 2.17%. Where should that be based on what you observe?
Well, it's hard to say. I expect the market-based expectations of inflation are going to drift higher. You can't say where it should be because inflationary expectations are unobservable. I think my read is, with this type of economic growth, not just in the reopening of the economy, but what I expect in the second half of the year and 2022, inflation is going to move up to 2.5%. That's a pretty solid number, which is high enough to make the Fed uncomfortable. And I just expect that's absolutely consistent with strong growth. And one thing I note in the Fed's March revisions of economic growth, they dramatically increased their forecast of real GDP above potential, and lowered their unemployment rate below where they think the natural rate of unemployment is, yet they still have their forecast of inflation anchored to 2%. It didn't add up.
Mickey, not a lot adds up right now. It's good to catch up, sir. Mickey Levy there, Berenberg Capital Markets Chief Economist from New York City this morning. Good morning to you all. Alongside Lisa Bramwitz, I'm Jonathan Ferro. The week isn't over yet. Morgan Stanley numbers coming in around about 1 hour and 20 minutes. And a big conversation into the next Fed meeting. Not just April, but June as well. In the June meeting, along with the forecast, a debate potentially around tapering in the future. Rick Reeder of BlackRock bringing that up in the last week. And I find it fascinating. We're already there. After the first quarter, after a couple of weeks of data, we're already having this discussion. Have we already seen the best of it? I find that unreal. Yields 157.45 on 10s, unchanged after a big rally this week. In the equity market, all-time highs, 41.64 on the S&P 500. From New York, this is Bloomberg.
The First Word News, I'm Ritika Gupta. There was a mass shooting last night at a FedEx facility in Indianapolis. According to police, 8 people were killed and at least 4 others were wounded. Authorities say the shooter killed himself. The FedEx operation is located near the Indianapolis airport. It's not clear whether the shooter worked there. In China, there's never been an economic rebound like this one. First quarter GDP rose a record 18.3% from a year ago. Of course, that's when the economy was shut down in an attempt to control the coronavirus pandemic. China's economies improved only slightly from the fourth quarter of 2020. Consumer spending had lagged during the early stages of the recovery, but it picked up in the first quarter. In Hong Kong, media tycoon and pro-democracy activist Jimmy Lai has been sentenced to 14 months in prison. Lai was convicted of attending 2 unauthorized protests. He also was charged with more national security offenses. Authorities have been pursuing cases against Hong Kong's most high-profile dissidents. That hold on the use of the Johnson & Johnson coronavirus vaccine could stretch out for several weeks. That's according to the head of an advisory panel that will make a recommendation about whether shots should resume. The CDC committee is weighing the evidence after reports that 6 people who received the vaccine developed rare blood clots in the brain. And it's the biggest debt sale ever by a bank. JP Morgan took advantage of some of the cheapest borrowing costs in years by selling $13 billion of bonds to boost its capital. The sale came a day after the bank reported its best quarter ever. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Minority myth wasn't something that was fabricated by the Asian Americans. It was created as a tool to alienate the Black and the Asian American communities, and it was incredibly successful.
We know that racism didn't begin yesterday. We know it's probably not going to end tomorrow, but it is our job to make sure that there's progress and we keep people safe, give people dignity.
I spent a lot of time last year to just listen, to understand, to reflect, and understand what I could do as a leader of this organization.
For many years, we've been very shareholder focused, and now there really is much more of a community requirement.
The economic downturn in the U.S., we're seeing unemployment and income losses affecting women more than men.
2/3 of the jobs lost in South Africa were women's jobs. So I think we're in a moment of crisis.
Clearly, our societies are reproducing, not producing inequality.
We need better public policy and we need companies to step up.
We're early on in this year. I know we've already sort of penciled in 6 or 7% growth and a big fall in unemployment, but under outcome-based policy, we really want to see that.
I'm bullish on the rebound, but I know we have a long way to go before the job is complete.
There's no textbook for this. You don't want to be too preemptive, but I also don't want to be so reactive that we're late.
I think it's too early to talk about changing monetary policy while we're still in the pandemic tunnel.
Customers, our teammates, and others are saying, "Wait a second, this, we think this is something we have to make it clear that we stand for the principles of a right to vote, and we shouldn't infringe upon that." And that's a statement that was from the weekend or earlier this week. And look at the list of people. Those are people that fall on all different political sides and things like that. This is about what America's all about.
Brian Moynihan there, the Bank of America chairman and CEO, catching up with Bloomberg's David Weston in the last 24 hours on the corporate stance in politics in this country right now. From New York City, alongside Lisa Abramovich, I'm Jonathan Ferro. Tom Keene taking a well-earned day off. I'm smiling down the camera because I know Tom's looking from the other side. I'm thinking of you, Tom. Equity futures up around about 2 points on the S&P 500. We're unchanged on the S&P. Into the bond market, yields coming in just a little bit. What a rally we saw yesterday. 157.28 on 10s. Euro dollar 119.81. But let's just sit there, Lisa, for a moment on the bond market. 157.28. A big week of gains for this Treasury market in the context of data, higher CPI, retail sales much better than expected.
Yeah, and it's not just in the U.S., right? We got the better than expected Chinese data, or some of it was better than expected. The GDP figures coming out really strong from China. So it's a two-pronged engine, if you will, when it comes to the global growth picture. Why are bond yields falling?
The conversation around is this as good as it gets? I find this so interesting that people have already shifted to that story. For rates for the bond market, it's going to be about what happens cumulatively through 2021. Just the additional growth, and the continued tightening of the labour market. Not the pace it happens, but just the cumulative process of it that reintroduces the rate factor. And I find it really interesting. We're sitting here today after one retail sales print saying this is as good as it gets, the bids back in the bond market, as if all you'll see is just one linear move. And as soon as you inflect lower, that's it.
Yeah,
it's a change of trend.
The interesting thing is that stock markets are following a different narrative than bond markets, right? I mean, we've got a new record high in stocks, and you've got this feeling of continued momentum underneath that. So the question is it as good as it gets? Did the bond market ever price in the boom, or is it never going to? And are stocks going to sort of be isolated in their own world for a bit more? But they're a really good discounting mechanism, and they've discounted a lot of good news already.
All-time highs in the equity market, and what a busy day we had yesterday. We had the bank earnings pouring through. We were anticipating a better than expected retail sales number. We got one. And then we had a series of headlines around sanctions on Russia from the US administration. And this week has been a big shift for this administration, a bigger focus on foreign policy. Let's bring in Jeannie Zaino, shall we? Bloomberg contributor. She joins us right now. Jeannie, can we start there? What stood out for you this week in foreign policy from the incoming administration, the new administration?
It was a big week in foreign policy for Joe Biden. He's about 85 days into his administration, and this week the focus shifted a bit from the pandemic and the push for infrastructure, as you mentioned, onto foreign policy, as we saw back-to-back big decisions. The first one being the plan to withdraw all combat troops from Afghanistan after 20 years by September 11th of this year, followed the next day, as you mentioned, by these pretty sweeping sanctions on Russia. They may not have gone quite as far as some people wanted, but it was a signal of a reset, I believe, by the Biden administration to let the Russian government and Vladimir Putin in particular know